Good morning, everyone. We are live on YouTube now, and we'll be starting our session in a minute.
Hi, morning, everyone.
Hi, Nilanjan. Good morning.
Hi, Aditya.
Hemant, you want to go ahead and start the session?
Yeah. Am I audible properly?
Yeah, perfectly fine.
Okay, fine. So, good morning.
Aditya, you
and
have to share the
warm
participant screen
I'll do
sharing.
that. I'll do that. Yeah, just begin. Yeah. Hemant Ji, sorry. Please go ahead.
Yeah. So, good morning and very warm welcome to all participants. Myself, Hemant Mehta, think tank multidisciplinary global platform chapter leader, welcomes you all to think tank global conclave for India growth story and meet the expert series, covering all the details: management think tank, valuation think tank, IBC think tank, radar think tank, FAFT think tank, ISAR think tank, financial reporting think tank, IPO think tank, and capital market think tank. As a major part of think tank at the rate Vivek Patra, Vivek in Sanskrit means knowledge and wisdom. Patra is an innovative news update containing slides on sharing latest development and real life examples by CEO, CXO, CFO, specialists, and professionals with global experience. Today we have think tank multidisciplinary global platform special meeting, industry and profession. Think tank has been in existence since over a decade. Idea for think tank conceived somewhere in January 1991 to have a conference conclave with CEO, CXO, CFO, panelists, and specialists, sharing experience and real life examples. Our panelists are financial leaders working in reputed company or profession since many years and have deep domain knowledge. Think tank platform now digital has got overwhelming response globally on digital mediums and expanding rapidly to LinkedIn, Facebook, etc. Our participants and experts have rich experience in industry and profession who have done CPA, CFA, IIM, CA, CS, CMA, ISA, DISA, IFRS, BTech, Masters, PhD. Uh, and you can visit our website www.thinktank.co.in. Due to overwhelming response to our annual report, corporate strategy and ESG, we have announced 6P awards. 6P awards and recognition. 6P stand for profit, people, planet, professional, promoters, and platform. It is for corporate achievers, CEO, CXO, CFO, with a very special jury with rich experience and in interaction with stakeholders and boards. This recognition and award would be announced with a rigorous process of scrutiny and choice and interaction with the participants. As participants are aware, recently we have launched a much-awaited referencer, approximately titled as Think Tank at the rate Vivek Patra, India Growth Story, a comprehensive conference material compilation over 600 pages sharing experiences by CEO, CXO, CFO, specialists with latest development and series on blocking, regulatory, fraud, financial reporting, Ind AS, IBC, taxation, digital capital market, technical analysis, ISA, bank audit, corporate affairs, and it would be available for subscription for any ethical contribution by well-wishers, etc. We will also be covering the important and latest development as suggested by many participants in coming weeks. Example, valuation, financial modeling, health is wealth, cyber security, blockchain, MSME, latest regulation, and development in various important professional bodies and institutions, etc. We request all to subscribe to Think Tank YouTube channel for watching summit, conclave, webinars, and join connect and network on Think Tank webinars, groups on LinkedIn and Facebook pages, Telegram channels specially created on suggestion of many participants and panelists. We once again welcome you all, members and panelists. I especially thank for colleagues in the digital global team, Anupam, Aditya, Ajay, Anurag, Archana, Ashwari, Dushyant, Mitesh, Mihir, Malvika, Manish, Nipun, Pramod, Praveen, Rakesh, Rucha, from R. Kanan, sir, then Santosh, Subrat, Snehal, Sandeep, Sanjeev, Umesh, Vijay, Vikas, Vikram, Yogesh, and others for regularly contributing to Think Tank. Today we have an excellent Think Tank, multidisciplinary platform seminar. Eminent stalwarts and specialists sharing their experiences and latest development. Let's have an interactive event. And with this introduction, I pass it on to Manoj sir. Manoj ji, over to you.
Thank you very much, Hemant. It's indeed a pleasure and privilege for me to be with you all. And it's a fantastic series. And especially today's topic, it has got overwhelming response. Many eminent experts have shared on this topic. And today, it's indeed nice. Falguni suggested to have a special series for entrepreneurs, CEOs, and virtual CFOs. Falguni has been doing a lot of good work in this area for quite a few years and has been on the board of several companies, including listed companies, and is interacting with a lot of corporates in this area. And along with that, we have quite a few speakers. Malay Damania is here with us. Malay, who has worked with a lot of corporates for a couple of decades and has also authored a book on business, right? Business, how to run a business. Champion of business, business champ. That's the thing. Malay is there, and we have many participants who have deep knowledge on business, running a business, startups, and latest developments, what is happening. So, Malay, you are there with us?
Yes, Manoj, very much. Good morning.
Malay, I would like you to share a few thoughts for about 5 minutes, and then request Falguni to start her presentation, and we'll make it a very interactive presentation.
Yeah, certainly. Good morning, everyone. And we are happy to have Falguni with us. Very interesting topic, actually. A lot of startups, the new and young entrepreneurs getting into this space. India has been the land of entrepreneurs. So this is really the startup initiatives, etc., is giving a big boost to the young entrepreneurs. I have been interacting with young entrepreneurs quite often nowadays. And they are very curious. They are very inquisitive, and they have got a lot of questions. some brilliant ideas they come up with. They have obviously they are high on energy and they want to really make a difference in the business world. Just that, they need a right kind of direction. They need some kind of mentoring and some sort of guidance, which if available, it will make a huge difference, not only in their life, but in the business world and the people at large. So I'm pretty excited to, with this topic when Manoj ji spoke to me that this is the topic on startup that we are coming up with, especially about the fundraising, where of course there has also been some sort of not a very clear understanding about how they can go about raising funds, what could be the reasons why they should raise funds, at what point of time, where they should approach, how they should approach. So there are a lot of questions around this particular area for the startup entrepreneurs. So would be pretty interesting. Falguni, we are really keen to listen and learn from your experience of how young entrepreneurs, especially in the startup space, can go about raising the funds. So I will not take more time, but Manoj ji, I will request you to take it again back and request Falguni to get going with her presentation. Thank you so much.
Thanks, Malay. Wonderful. And Malay, I hope you have the book Business Champ with you ready. Later, I would like you to share the copy. If you have
sure. It's with me. Yeah, sure, certainly.
Yes. Yeah, Falguni, over to you. Let's have some insights from you and make it very interactive.
Sure. Thank you so much.
Yeah, and Falguni, you can share a few thoughts about a few words about yourself, the work you have been doing, the experience you have gathered, and then we'll get to the focus on the core session today, and lots of topics ahead by you and professionals.
First and foremost, very good morning to everyone, and I would really like to thank Think Tank for inviting me for such a wonderful series. As Malay said, this is the most hot young entrepreneurs startup has been in the corporate world. This is something that everyone is excited about, and thank you Hemant ji and Manoj ji for giving this opportunity and setting up the stage to start the conversation. And thank you Aditya for helping in setting this up. Yes, I am a chartered accountant having industry experience now of more than 25 years. I started my career with consulting, forensic consulting and special consulting, ERP consulting. And after that, I joined industry. I worked for various public listed companies, MNCs, including the Future Group, the Phoenix Mills Ruyas, the Soros Chatterjee Group. I have also worked with multinational company, Sabre, Travelocity. And my last stint was also with a public listed company, Tribhuvandas Bhimji Zaveri, where I worked with them for 8 years in their key management team. As a key management team, I was handling the entire key bullion supply chain for them for their gold jewelry. So having worked for more than 25 years in the industry, I decided then to take my own plunge of entrepreneurship. And I started off on CFO advisory services. IX CFO platform, where I am a partner, is a CFO service platform since more than a decade now. And we have, catered to more than 200 now on pan-India basis. So we are helping entrepreneurs and startup companies, mid-sized companies, family offices, and businesses on a high traction and high growth mode to take up the next leap in their growth journey. So here I am, and I selected when Manoj told me about this starting a special series on entrepreneurs. I felt that one should start with a topic of fundraising, because fundraising is a very, very key important element for entrepreneurs to keep in mind when they are actually starting their journey of startups. So I selected this, that what is an investor deck? What are the inclusions in an investor deck that one needs to know at their mindset of what investors are actually looking for? Because yes, I do understand that entrepreneurs have a lot of energy, they have good ideas, but all those will get fructified once you get successfully fundraising from the investors. Because once it is bootstrapped also, you only take it up to a certain scale. If you want to really scale it up to the next level, you will definitely need investors to join you, whether it can be your family, it can be your friends, it can be venture capitalists, it can be the outside world. But you definitely will need the fund support. And that is the reason why I selected this topic. And I thought that, let us start this series with this topic, which would, then set some stage for the startups to then go to the next phase. So Manoj, with your due permission, I'm starting my presentation. So investor deck, it's a very important tool for the fundraise. Many startups, as Malay said very correctly, the entrepreneurs today we are seeing, they are having full of energy, very brilliant ideas, out of box ideas. They want to really understand why and what, and they want to make a difference. They do startup. Their ideas are so brilliant that what happens is that they start up the business, and then up to a certain stage, they of course dry up on funds. And when they are looking out for investor funds, they have so much of time lag between preparing what the investor is actually looking out for, understanding what actually the investor is looking out for, and how they need to put the pieces together of their business to convey to the opposite person or the investor. And because of this time lag, because of the dry up of funds, many startups we see do not come to the, do not go ahead and die. So that's the reason why we want maximum startups to get successful and to the unicorn journey. So in startups, a key theme that has emerged in India startups, a startup ecosystem or a landscape, especially since the onset of pandemic, has been significant digital acceleration fueled by smartphone penetration and growing importance of technology as an enabler across sectors business models. Of course, fintech and e-commerce has still continued to be the most favorite for investors. But however, the digital transformation has also gone to other industries and other areas of, other services, including agri-tech. Agri-tech is also moving very, very fast and very gaining momentum. And large interest from investors. So in 2021, even though it was pandemic, we saw that the investment market was flooded with investments, and that it was a history in the Indian entrepreneurship with 42 Indian unicorns. And 2022 has been a significant important year as we have reached the 100. India now has more than 100 unicorns. In fact, it has surpassed more than 100 unicorns. This was the first quarter for 2022. So what is a unicorn? Unicorn is $1 billion valuation. If your company has a $1 billion valuation, it is called as a unicorn. And India has now seen that we have decacorns also. We have more than 10 billion valuation is called decacorn. So Flipkart, Nykaa, Swiggy, and Byju's educational app, it has all the four have gone to decacorn. They have been valuation more than $10 billion. So yes, do you also want to be one of them? If not already, you definitely can get there. The VC investments in India, you can see on a year-on-year basis. This is the quarter one of 2022. So you can see almost we are jumping more than 100% from year-on-year basis. And the deals are also increasing in the VC space. So VCs and PE companies, their involvement in your business would be great when the business achieves certain specific ARR. What do we mean by ARR? ARR is the annual revenue, recurring revenue. Right now, whatever revenue are you touching? Like if you are in the month of May and you have touched a revenue of the top line of 1 crore, I would say that my ARR is 12 crores annually. If I'm in the month of December and I have reached 1 crore traction, I would say that my ARR is 12 crores. But even though in the April to till April to November, I may have done less than 1 crore as a top line in monthly basis, that's fine. My financial year may end at 6 crores, but I would say that my ARR is 12 crores. So ARR is a very important term for the VCs, that what is the traction that you have now reached? What is the annual traction that you have reached? So the PCs and the PE companies would get involved in your business only after a specific ARR or quantum of transactions that you will reach, the revenue you will reach in your business. So it's the angel investors who will meet the operational requirements and help you in your early stage requirements. So who are these angel investors? They are individuals with high net worth. They want to invest in small businesses or startups, ideas. Only when it's an idea also, they will just invest in you. They will take a part of the equity investment share from you, ownership share, and they will invest in your idea and give you that capital, working capital, to gain that kind of an ARR, which then the VCs and PEs be involved and would be interested to take it up from there. So what are the key insights one needs to when you are pitching an initial pitch to the investor? We have to be extremely careful that how do you pitch to a startup? Keep your startup pitch very, very simple. Keep it manageable. See the timing of your startup pitch. Tell your startup story and please stay focused. Do not make 60, 70 slides. Nobody is going to read that. And then by the time you reach on the 10th, 12th slide, the idea would be lost. Make it perfectly focused, not more than 15 slides. The review committee as well as the investors are very keen to understand if the concept addresses a real opportunity. So you have very few seconds for them to understand, and please understand they do not know your business. So you have to make them understand your idea in a very layman terms, in a very pictorial, in a very graphic form. You have to use a lot of graphic diagrams and flowcharts to make it very simple, comprehensible, and make them understand that this is my idea and this is where I will click the clock. So make it very concept-wise or real. Too many numbers and details on the initial stage should be avoided, because unnecessary, it will consume so much and it will get defocused. Your idea will be lost somewhere. They will only try to venture into too much numbers. So right now the too much numbers are not needed. You may keep it handy, but do not fill it up with too much numbers. Bring out the business case very strongly. What are you into? Get the business case sold to them in your business pitch the moment they see your pitch. So the investor deck layout, flow and inclusions. The first section would be the brief of the company brand, the company logo, what the company is all about, what is the URL that you are operating, very important. What is the business URL and which city you all operate from, and where are your what is your presence, whether it's pan-India presence, whether it's global presence, what it is, your company. In very crisp initial first para, this should come out that your company's presence is in what is the name of the company, what's the brief profile. Then what is it that, there's a very favorite question all investors want to ask. Please define your company in one line. What are you doing? What do you want to, what is your idea? Please define in one line. So I have seen narrations of people writing about, of course, because they are passionate and they know about their business so much, writing few pages on what they want to do and what is their business and all that. sorry, we need, all the investors would ask, what is it that you want to, what is it that you are doing? Please define it in one line. So the vision and mission of the company is very, very important and critical to note it down. Like I'll just give you an example of PhonePe. PhonePe had a vision statement that it wants to build a large, scalable and open transaction ecosystem that creates the maximum positive impact for all stakeholders. Now, this is a long-term vision, okay. But what is their mission statement? They want to stand as a universal. Now, every word over here will count. They want to be universal. So, somebody will say globally, somebody will say, you know, in Indian context. So, to stand as a universal, seamless and safe mobile payments ecosystem. So, it is very, very clear in what it wants to do, where it wants to be. So, like that, your vision and mission of the company needs to be defined. So, you have to think about, do you have a one-liner that explains your business? And the first section will then close with the team, which should also be only one slide. Your key team members. So there are many family offices, many young entrepreneurs in the family offices who are wanting to take up the business in a new way. So it is kind of, called as a new startup company, or they are developing new startup company. So there we see that they do not, they only have a single promoter. It is not having co-founders. So investors would always look at that. Do you have a strong second level leadership team? Do you have a leadership team which is going to then take this to the next level? And whether your ESOPs are in place. That time the ESOPs will be very important, because all the investors are investors who want to invest are very, very keen to know whether the company has adopted any ESOP, what is the plan. Why? Because it then shows them a long-term continuity of your business plan. And it understands that the key team who is going to work right now on your ideas are going to take this forward. So when you are writing about the key team members, please do not write about so much of the background experience, but what experience you need to bring out of them and need to come very clearly on the slide is what they are right now contributing to the business and how that experience is going to leverage us in this. Like say, suppose if I'm starting off a beverage company, I have an idea of a beverage company, then I would say that these team members have a Pepsi experience. Or, example, I'm just giving an example, but something that is going to directly relate the key team members' contribution to your business. What key role is he playing in your business? So that's what you have to bring it out very clearly. Not more than one slide. Yes, a picture of them and maybe what they want to, how they want to do it, and what is it that they are going to bring to the table in your business. So this is what it is. So if you do not have, usually the investors would prefer core, but if you do not have a core also and you have an ESOP in place with a very strong leadership team, well defined, I think it would meet the purpose. So the second section, the most important section of the investor deck, is then coming to the business details. So business details is now you are coming to what is the problem that you are trying to solve, or what is the unmet demand that you're trying to meet. Okay, so this is what is the differentiation of the product or the service that has to be very, very loud and clear. Friends, if you do not, get your ideas are definitely very, very good. If you sit with me 1 hour on chatting, I would, be, wow, what an idea. But we have to understand that right now the communication between you and the investor is this investor deck. So you have to make the pitch in such a way, the document in such a way that it captures all your zeal, energy, and what you want to say. But the service that you are offering or the product that you are offering needs to be very loud and clear. The differentiation has to be very loud and clear. And you have to also kind of explain in this slide why there is a big market for the services or product that you are offering. Okay, what is the problem that you're trying to solve and why there is a big market of services or products, and what is the uniqueness? What is the uniqueness that you're bringing in? How the technology is going to differentiate? What differentiating technology are you going to use for this services or business that you have planned? Technology is forming a very, very important part. As I told you in my initial, digitalization has taken up entirely, technology today has gone from simple software to the AI languages and natural processing languages. So what is the technology differentiation? That would also form a very important part. Technology sometimes explaining could be this. So I think a diagram would very, very clearly describe how differentiating your technology is and what value it's going to get added to it. So this kind of business detail is actually your, you have to bring out what is the problem you're trying to address, what is the solution, and addressable market size. When I say that, why do you feel that there is a big market to this? Now the addressable market size also, it has to be target addressable market size, TAM. They call it as TAM. So say suppose if Byju's is going for setting up, Byju's is saying that my addressable market size is anybody from year 6 to year 21. I'm providing, or maybe, till 16 years, okay, I'm providing an online coaching classes for them. So anybody, the population of India, if they are right now, they have also started 3 more countries. But I'm saying if it was initially for India, they would say that, okay, my target size is India's population between age 6 and between age 16 is this. Okay, but no, what is your target audience? Byju may not be wanting to target all. So Byju will say that, yes, out of this total population from age 6 to age 16, if their total population is this much, my target audience is that I want to only cater to English medium education system. So my target, addressable target size would be less than that. So that is what has to come very prominently, that total market size, addressable market size, my target market size. Now, the difference between why I need to put the addressable market size and the target market size is that in future, if you want to go between the difference, once you have, scaled up and unleashed the complete potential of your target audience, audience, you can always go back to the difference between your addressable target size and this. So you can, again, that is a potential in future that the investors would want to look at. So there's no harm in providing that number as well. Everything very, very precisely in only one slide, with a lot of numbers that should be coming in. So this is what I wanted to, say in this slide. So does your product speak for itself, and what is the technology differentiator? So, when you want to talk about some payments company, you want to say that earlier in the era between 1994, before offline payments were happening. Now in 94 to 20, we are all on the online payments through aggregators. Okay, then in 20 era, 20 to 2030, now it's AI payments, more direct, and AI. So a lot of artificial intelligence is built out. So what is there in the next era? So I'm just saying that, when your ideas are getting presented, you need to then relate to whatever block we have said, how you are going to make a difference in this 2020 to 2030, and how your product will then meet the next era, how your technology differentiator is going to then meet overcome the traditional methods and get into more demand. So technology differentiator can also be like, I'm using a global agribusiness is now served in a single button. So what is artificial intelligence, machine language, natural processing language? So it becomes real time and easy to adopt. What is the digital and automation you're bringing in? The costs are reduced, margins are high. You're bringing it in multi-language. You are getting into multi-currency. You are saying, go local, I'm ready. So, what kind of differentiation are you bringing from technology point of view also is very, very important. So now we come to the next phase of the investor deck, which is the scalability. Friends, scalability is extremely important. I have a brilliant idea. If idea is not scalable on a very quick basis, then the startups will lose their gauge, because the investors will lose their interest. What the investors are looking out for is that how quickly will you be able to scale up your operations? You have a brilliant idea. You have got a brilliant ARR till now. You have set up the business, but taking it to the next level, is it going to be again going to consume founding years? No. So they don't want, say, suppose if you started your founding idea in 2018 and now you are in 2022, reached an ARR and you are going for investor pitching. The amount of time that you took to set up this business and bring this ARR, now to get up to the next scale, they don't have to wait so much. You will be able to get up to the stage from 12 crore to 100 crores in just maybe probably the same year. So scalability is highly important. In that, what you need to focus is who are your target customers? What is the competition that is going around you? You need to bring it out very clearly that who are your competitors whom you are perceiving as? What is the traction that you have reached till now? What is the meaning of traction? Traction is that what I just mentioned to you, that till today, what have you actually done? The investors, the VCs will only come into picture when you have achieved some kind of traction. I have achieved 10,000 transactions till today. I have achieved a customer base of 20,000. I have signed up with at least 12 partners, B2B partners. I have reached the top line of at least 10 crores monthly. I have got users, X users already on my customer base. So these are all tractions. So I have a traction so far. So you can make in this one slide, like what is your cumulative GMV, that gross margin value that you have achieved till now? What is your financial year GMV? What is your GMV for the closing year, the annual? So in one chart, you can bring out a lot of things. This is also current traction of a processing, a loan processing idea. That what are the transactions you have processed till today? What are the KYCs you have signed already till today? What are the databases and users? And this chart shows what is the traction on month-on-month basis, that your transactions are going up, your number of ARR is going up, your annual revenue is going up. So these are some slides on the traction. So you have to bring out the traction very, very clearly. And the next part is very, very critical, is how do you reach your strategy? How do you, when I say reaching the strategy, how are you going to penetrate? How are you going to position? How are you going to price? And because you all are already aware that a very traditional method of 3 Ps are a key to reaching profitability. So how do you plan to market yourself, market your product and your services? What is that you do to anticipate acquisition costs? Okay, what is going to be your COA? COA is the cost of acquisition. So when I am, suppose, in a business where I say it is a store, it is an online store. Okay, I'm selling products on my online store, multi-culinary material. I'm specialist in that and I'm selling that online. What would be my cost of acquisition is that it's an e-commerce business for me. So for me, every customer that comes onto my site and then buys the product, okay, what is it that takes me to spend to get that user to come to my website, convert and buy? So the advertising spends, how I'm going to get that user to come to my site and convert, is the advertising cost or the marketing cost that I'm going to spend. Okay, and that divided by the number of transactions is going to give me the cost of acquisition per user. So if, say, suppose in this month, I'm going to spend 20 lakhs on SEO, on SEM, and I'm going to get out of that, say, 20,000 users, and out of which only 2,000 will buy my product. So 20 lakhs divided by 2,000 rupees, who have finally bought the product, is my cost of acquisition per user. And what is the LTV? LTV is the lifetime value of a product. So a lifetime value of your customer. So this customer whom I got after spending 20 lakhs, I got 2,000 customers. They bought with me, right? Of course, my product will also define my conversion levels, that whether the customer will come again or not. But here we are assuming that my products are very good and that the customer would like to experience it again. So what is the lifetime value of your customer that you are anticipating that customer to now again? You have the acquisition cost has already got you have already incurred. He knows about your product now. He has already experienced it. So we have to assume what will be his lifetime. So we are assuming, okay, 3 years he will be with me, and he will keep transacting with me, and on a yearly basis, need my product at least 3 to 4 times. So my lifetime value, my average ticket size of a product is 1800. So what we have to say is that, okay, 1800 into 12 times, because he's going to be there with me for 3 years. And every year he will transact 4 times. So 1800 into 12, whatever is the sum that comes up to, will be the lifetime value that I will achieve from the amount that revenue I will achieve from this customer. Okay. And then whatever margins are there. So what is the ROAS? Is my return on advertising spend. So how much margins am I making from this total sum, which I told you, 1800 into 12? What is, say, suppose if my margins are 5%, 8%. So and out of that, 8% will be my numerator, and divide by my marketing spends will be my return on advertising spends that I'm getting. So this mathematics needs to be very clear with you all. So when an investor is seeing, and when you are, because marketing is forming a very, very important part in your fundraising exercise. That's one of the important part why you would be asking working capital. And that's a very, for startups, the main cost is the marketing cost. So this is what you will have to explain in a very beautiful one slide. Maybe your ROAS initially may not be, positive, but you have to show the path to being it positive. So in that one slide, they should be able to understand that where you are today and where, in terms of reaching your market size, where you are going to be. Because friends, if you have a brilliant idea, you have a brilliant service, you have a brilliant product, you have developed it, you have a fantastic team. But finally, if your products and services are not being utilized, or they are not aware about in your target customer audience, then it is going to not get you to the goal. So this reach strategy needs to be very, very clear to yourself. You need to know the maths. When I say do not spill it up with too many numbers, but these numbers have to be the crisp numbers of what is your cost of acquisition, what's your lifetime value of a customer, what is going to be your return on advertising spends. These are going to be some key criticals for an investor to separate you from the other startups who are not aware about this. So we have to remember, go to the unicorn. We have to become the unicorn. So we have to ensure that these things are always embedded with us. We definitely know this maths, and we are understanding that our marketing ROI is positive, or at least when it's going to get positive. These are some timelines also, where as to your company wants to, where are you positioned right now? What was the journey of your company, and in the future, how the journey is going to be. So you can just define it in one slide. Like I've given you a few, just some formats just for you to show that, everything needs to be defined in, since you do not want to increase more than 12 slides, your entire growth story needs to come in that one slide. So you can put it in various pictures. You can choose, between various, like from the time journey, like from 21, 24 where you are, and from 24, 2030 also where you want to be. So your growth journey can also come in a very pictorial way. So now we come to the financial part. The investor deck, when I say do not include too many financial numbers, but there are a basic thing of unit metrics. What do we mean by unit metrics? Your finance model needs to have a unit metrics in place. Is that number of transactions that you are achieving? It's in number quantity form. What are the number of users, number of transactions that you are facing? What is the total top line that you have achieved? And what is it that per transaction will be your top line? So it will be a quantitative data. Unit metrics is a quantitative data of your business, what you are doing in terms of number of transactions, each product wise maybe. If you are having a B2B business, B2C business, hybrid business, maybe you can give of all the 3 businesses unit metrics of how many transactions you have achieved, what is your average ticket size per transaction, how much are you, what are your gross margins per, gross margins in B2B, B2C and B2E. And so you will then, from a unit matrix, a person will be able to understand that when you do a B2B transaction, you make margins, when you do B2C, what it makes, and when you do hybrid, what it makes. Different models will have different unit metrics. So, and then you can have current financials and ARR. So this also needs to be not more than in one slide. Do not give more details. You have to mention about your top line. Okay, unit metrics has already taken care of all your transactional details. You have to, in current financials, you have to maintain, you have to very clearly show your top line. What are your direct costs, total direct costs? Do not break up too much into too much details. Your direct costs, your gross margins, and your costs below the line, which will be only of 4 to 5, like personnel, marketing costs, your other costs. So there HON admin costs. So there'll be only 3-4 heads which will come, and then there will be EBITDA and what is going to be your PAT. So projected financials also will be only one slide. It will not be more right now at this stage. When the investors gain attention, you want to keep it everything ready. That's fine, and you have to get yourself geared up to everything when you're pitching to the investors. Maybe live, maybe on a Google Meet. Maybe you are just sending them sometimes a pitch. They say that, okay, we'll review and come back to you. You may keep it handy with you, but do not include too much on it. Just keep it very, very, concise and precise for them to understand what the business finance is looking like. And projected financials, of course, of the next 4-5 years, you want to make one sheet where you want to say that, okay, my revenue is 10 crore right now, it will go to 100 crores, my PAT looks like this, my EBITDA is this, my marketing expense the broad marketing expense, my personal costs will go up from year to year. So for them to gauge, of course, that, what kind of tractions have you assumed, what kind of growth strategy you have assumed for yourself. So that projected financials can come in one slide. And of course, ratios always help. So, any one slide, like how I showed you the traction slide like this, in this one slide itself, you can give ratios. Do not make it like too many, one slide like this can be on marketing also. Whatever I told you in marketing, that can be precisely done in this, like how many users, what is the cost per acquisition per user, what is the, traction that you are getting, what is the ROA, return on your advertising cost. So, you can make it in very, very simple pictorial form. So projected financials, of course, would be important. Now, more important in other financials is that what is your break-even sales? Are you clearly defining that? That when are you going to, have you already been in profit? And if not, what's going to be your stage? So that investors should know that, okay, from 10 crore, when I'm going to 20 crores, or when the business will go to 20 crores, that is when the break-even will happen. So that break-even sales, whether it's clearly defined in your projections, and whether your fund requirement, whatever is the capex that you are including, whatever is your fund requirement. Of course, capex sheet also should come out in a very, very clear manner. Out of your fund requirement, how much you are going to spend on capex. Now, the main and the most important part, why we are doing all this and why entrepreneurs should be so much interested in an investor deck, is, of course, the ask amount. What is the amount that we are asking? Because at the end of the day, we all need funds, right, to get our business to the next level. So what is the ask amount should be very, very critical. This is the critical part of the slide. Do not, put in again too many details. Your ask amount has to be very, very clear. What is the amount that you have, what you are expecting from the investor, and how do you plan to spend it? Again, not more than one slide. Your one slide should explain everything. So what is your ask amount? Your ask amount will be the capital that you require for going from an X stage to a Y stage. Okay. It can also include your cash flow gaps. Friends, what do we mean by cash flow? We all know that we are operating in different, in different operating segments when we are business segments when we are dealing with. It may have a lag in the cash flow. What I mean is that you may receive your debtors. Maybe you are giving a 8 days lag to your debtors, or you have a 15 days to you are giving credit to your debtors. However, to your customers. However, certain payments you have to pay upfront in your costs. So there will be creating a gap in the cash flow. At the same time, there are businesses where they get upfront money from their customers, but they have to pay their creditors at a little later date. that time your cash flow is generating positive cash flow generation, positive cash, right? So both the things you have to be aware about, and you have to take into consideration when you are asking the ask amount. Okay, otherwise the investor will ask you are from reaching this point to this point, you're asking me this money. This is the capital you will require. But what about the positive working capital cash flow that you're generating? Have you subtracted that from it? So then your ask amount also changes. Then your investor base also changes, because you know that investors are categorized into different, up to 1 million, there is another, investor VC fund. Then, below 1 million, there will be another VC fund. So VC funds are also many times divided into the amount of money that you want to ask from them. Certain VC funds would not go below a certain threshold. So if you're not falling in that, they would not want to, look at your pitch. So what happens is that you need to very, very clearly know that what is the ask amount that you are asking. Have you taken care of the cash flow adjustments? Positive, negative, whatever your cash flow is generating, you have to adjust it in your fund requirement and then kind of put it to them. So this all things will then put you on a very different platform from the other entrepreneurs or startups. The investors would definitely understand that, the people, the promoters, the startup entrepreneur understands what this business he's doing and what he has in plan for himself. Okay, so the ask amount and how do you plan to spend needs to be coming out very, very clearly. And how long will this last is also a very, very important thing. Okay, what is my current runway? When I say runway is the amount of fund that I have right now to survive myself. So say, suppose if I'm having a cash burn of monthly 3 lakh rupees. So now I have a positive, net current assets of maybe 10 lakhs as a cash flow with me. Then I will say that my runway is only 3 months. I only have 3 months for my this to serve my business. So what is the runway? And when you ask this amount from the investor, how much is this that where you are going to reach? And this fund will get used, because sometimes the fund requirement is so high, but the, startups are coming up with a smaller fund ask. Ask is very small. They are saying that, okay, at this point, we don't want to, do valuation for we don't want to give up all our equity. So we'll take little funds and we will go to the next traction level, then approach the VCs. So be very clear about the runway. There's no harm in asking for funds in the mid, for getting your traction to another level and then going to the VCs or anything. But just know that what is your cash burn, what is your runway, and do you have a contingency plan? Say, suppose if your investments take longer than 3 months to arrive, what is going to be your contingency plan? Also, what is an exit option for the investors? You may not put all this on the slide, but please be ready for you to discuss it with your, when they are going through or when you're presenting, these questions may come up. That what is the exit that you are what exit options are you having envisaged for the people who are investing in your company? Okay, and what portion of your total will form your total requirements? So this is on the last critical part on the ask amount and how you plan to spend it. This is the one slide which will show on the ask of the usage of the funds to drive the business by 10x. So what here it's a sample slide is that I want to grow. This is the ask for usage of, say, suppose if I'm asking for 10 crores. 10 crores of funds to drive my business by 10x in 22-23. So from my B2B, my working capital requirement would be, say, X amount. My sales salary will be X amount. Why sales separately? Because as I told you, whatever marketing that you're doing today may not necessarily reap you revenues for today, this year itself. It will go over a period of long term. So when you are presenting, your gross margins have to come separate. You can put your marketing a little separate. So they know that your business is actually profitable, but it is because of this marketing that you're spending, which will over the period of time reap revenues. You are spending that right now. So there is this total for your B2C business, 100 customers. What is your HO cost you separately define, which will include, maybe the tech investments, you include your people investments, other expenses, whatever. And then for your continued scale up, what are you going to do? By doing this, by deploying this 10 crores, you are going to achieve 20,000 new customers, 8 lakh new transactions. Your top line is going to increase by so much. Your launch and your scale up is going to be so much. So you give that summary also down. So they know very clearly that my 10 crores is going to get utilized in these. It will get from me from a 10,000 transaction to a 10 lakh transactions. It will get my users from this side to this subscribe. It will, get me more scale up in terms of various mathematics that we have shown over here. So this one slide will very, very clearly then get to the investors. What is your ask amount and what is the usage of funds that you are going to do? So thank you very much. This was the end of my slide. We can have question, answers and interaction. It's open for all of you all. I hope you all found this helpful and interesting. Manoj, are you there? Hi Malay, I hope you
Hi
found this
Falguni.
interesting.
Hi
I hope
Falguni.
you found this interesting.
Yes, Falguni. I was just unmuting myself. So yeah, very, very interesting and informative session. And I'm sure all the startup entrepreneurs who are in this space as well as who are wanting to get into this space will find this extremely useful when it comes to raising funds from investors.
Because
And
Malay, what I saw was that, even companies who are right now at the traction level of 50 crores, when they want to actually raise funds, at that time, when they have got exhausted out of their bootstrap money, at that time, they come to know that there are a few critical things which are not in place yet, what an investor is looking at. So I thought that, when an entrepreneur is starting his journey at that time, only if he knows that, okay, maybe all this, what I have said on this slide may not be there. Those transactions may not be there at that time. But if they have the projections and the vision for all this, then also if they are able to explain, then it will go through with the investors very well. And that will help them to get the fundraising cycle to a shorter time. And it will amount to a successful pitching.
Absolutely.
So because we want more and more startups to go to the unicorn level and, ensure that the startups do not, the brilliant ideas of the people and the efforts of the youngsters, it shouldn't go down the drain. And just because of the dry up of funds. And because India is seeing so much of traction on funds right now, I think that this is the best opportunity for entrepreneurs to, the government boosting and a lot of other things that are in favor. I think it is a best time for entrepreneurs to go all out.
Absolutely. So true. Having that mindset at the beginning of their journey,
yes,
and setting the vision that this is where they want to reach at
yes,
the end of a particular period. I think that
correct,
is so important, so
yes,
that they can really lay out a journey to reach out to that space.
That's very true. That's very
absolutely true. So Falguni, I just had a question. I was thinking, you see, many of these startups, yes, they have obviously brilliant ideas and they start working on their ideas. They do get some traction, and I'm talking about the people who are in initial stage. And as their ideals, they look at this, the unicorns of the industry. And many of the unicorns, we have seen that they have great subscriber base, great traction. But when it comes to profitability, they are very poor, or probably many of them are making huge losses as well. But they are taking, they have huge traction. Now, what would you advise to a large set of these kind of startups who are not really backed by the kind of funds that these unicorns are, but so should they focus on profit? Should they focus on the top line and the subscriber base? And, how should they balance this part?
Very, very important question, Malay. What happens is that, yes, we do have the likes of Ola and Paytm and all that for a long time, Swiggy, and everybody was onto a negative, EBITDA. But let me tell you, the scenario is fast changing now. People are wanting to know your bottom line effectiveness. Yes, why those companies have attracted a lot of valuation on their user bases, because in e-commerce, users are the one kind of an asset. They are looking at an capex kind of an asset, that once the users are hooked on to your part of the story, and they are hooked on to your the lifetime value of that user should not be only restrained to that year. How I earlier explained to you in my PPT is that show your marketing expense separately. So when it comes to gross margins, all these guys are profitable. But when it comes to EBITDA, they are all negative, because they are spending huge on discounts, they are spending huge on marketing, they are spending huge on acquisition cost. So the acquisition cost can be in basis of advertising, giving them freebies, giving free discounts to people, for attracting them, discounting the product. So it could be in number of forms. Your marketing strategies could be brand building. So brand building again cannot be put it to. So what they will do is, then they over the years, then they'll put an amount to a goodwill that they have generated out of it. Today Ola, we all know Ola, how the brand has evolved. So if you go by the pure mathematics of what they have spent in that year, including marketing, including branding and everything, they'll be EBITDA negative. They'll be hugely deep. But if you go to their gross margins, they all would be making profits. And that's the idea that the VCs are buying. But what differentiation your technology, and now the smart way of, how I'm seeing the startups and what the expectation of the VCs is, that you definitely have to be profitable. So, the journey, the mindsets of the people have changed. People know that, you have to get profitable. Of course, they have that kind of vision of 2 to 3 years. They have the waiting period that, in 3 years, you get into a profitable mode, even EBITDA level. Initially, you can be gross margin profit, and then you can spend on branding, advertising, and all that. So, this is what, your idea could be winning, that if all others are making losses, today, all travel companies are making huge losses. So if a travel company, online travel company, wants to make a differentiation, he will say, look, others are bleeding. Make My Trip is bleeding. He went to NASDAQ to list his company. But the amount and size of Make My Trip has gathered him that much of premium and, the brand. So what I'm trying to say is that if they want to make a difference, they have to become profitable.
Sure. This is so important.
It is very, very, very important.
Startups.
That's why if you would see that in past few years also, a lot of VCs were wanting to fund a lot of B2B business instead of B2C business. They were more keen for B2B deals also, because B2B was gaining a lot of momentum, because B2B has volumes, and it is, less in terms of marketing spend. We have to spend that much less. We don't have to spend like B2C. So B2B has a greater advantage in terms of profitability, and the VCs were preferring to have a more B2B models.
Absolutely. So what I'm hearing you saying is that depending on your business, entrepreneurs need to balance between the top line, the profits,
and the bottom line, and
also the sustainability that they can have, depending on at which stage of business they are and what sort of funds they have. So
also a revolutionary change in the way they will look at marketing. Earlier, we knew that if a brand wanted to come, he had to spend 5 crores in advertising on TV. He had to do, when the internet game started, also people know that, I have to spend on online media, SEM, SEO. But now there are smarter ways in which you can, do that. And that's going to be the differentiation, how you're going to reach your target audience in the best possible minimum cost.
Absolutely. Thank you so much for explaining that very important concept in detail.
Correct.
Just one more thing. I just want to get your view on is these entrepreneurs. When they approach the investors, they are looking at one, obviously getting money in the company for furthering their vision in the company, but they also sometimes look at partially exiting by way of withdrawing some money from the company, because they have put in a lot of efforts in the initial stage, and probably many of them have not charged the company also of their efforts and time, etc., that they have spent on the company. So just want to get your view of how do the investors view this proposition, putting the money in the company vis-a-vis letting the promoter get back some money out of the company.
Correct. This is also a very important question. That's why when I started my slides, I had said that, many bootstrap companies say, they have spent and gone to such an extent of spending that then what you said was that they want to offload certain part because, they have not been taking salaries. They've already invested their own 10 crore rupees, maybe, from family, friends, and their own sources also. So what happens is that I would suggest, and my urge would be to all the youngsters is also that whatever capital you have, do not wait till it gets over to, go for fundraising. I do understand valuations. I do understand. But if if your business is profitable, there are n number of debt platforms right now that have come into picture. Okay, a lot of debt platforms are there who are based on your cash flow are giving you finances. You can go for them if you are able to service the interest cost and get to a certain traction level where then you will get good valuation. Second, you can also go to new initial angel investors who would take you to another level. But if you entirely dry out your funds, and then if you have reached the traction level and if you're going to the investors, there is no harm. Even the investors are open. They also understand that the promoters have put in their money. But it is at which stage. It depends on which stage of your business are you at that you are asking. Now, if you ask angel investor that I'm going to take out, my money, then it's not going to work out, right? I mean, he is giving you the money to get you to another scale. Same, the early venture capitalists, the one who will invest, would also want you to initially have your stake in that. So initially, they would want the business to go from a certain level to another level. And then kind of, you taking out your funds. So that can be written in the agreement very clearly. The term sheet can mention all of those. But I would request that you should have raising funds when you do not dry up completely. So that you have that waiting period with the venture capitalists, because if you try to tell them that you want to exit certain things, then that gets your valuation to a very compromised situation. You may still get it, but your valuation will be at a compromise. He will understand your need.
Absolutely.
And they are looking at more of partnership to get their money to first deliver the business, get a value for them, and then you kind of look at exit options. So that gets your valuation to a completely different pitch.
Sure. Thank you so much for explaining that.
Yeah.
And maybe if you have some, if you can throw some light on what are the expectations of investors, usually when they what do they expect from putting in their money?
Malay, the maths is simple. How much money are we getting on safe investments right now? Plus the risk and the premium that they are going to get exposed to for investing in your business. They at least need to generate that much, right?
Absolutely. Yes.
If they wanted currently, if their funds would be invested in safe havens, they would have get an X percentage. Plus the risk and the premium that your business is going to give them. Okay, if you are in a business which is a very safe, sound, and they don't have to worry, your premium would be less. But if you are having a business where their risk appetite is going to be very high, the premium is, of course, their expectation on ROI will be higher, right? So it all depends upon those factors.
All right.
Ultimately, they have to get returns as well as they have to get a good valuation of this.
Sure. Thank you so much, Falguni. I will let Manoj Ji, if he's there.
Falguni, madam, shall I add some points?
Yeah, Umesh Ji, please.
Yeah. It was a very excellent presentation by you, and from the very basic level, you have taken up all the details in the minds of the investor or in the minds of the startups. One point, let me have what are the objectives set by the investors when they are investing something in a startup? Because there are different types of investors. So, what is the objective is in the mind? One is the earning, one is the valuation, and then getting up after a time out of the business. But there are so many things. So, how they see the project and what objectives are set while investing in startup? Can you just explain this point?
Yeah, sure. Unmesh, what happens is that there are various VC funds. There are certain VC funds who are only investing in real estate. There are certain VC funds who are interested in only D2C businesses. And there are certain who are only interested in B2B businesses. Okay, investor funds are also divided based on the need. Like there are certain investment funds who will say that our requirement, pre-requirement are these conditions. Are you meeting an ARR of 1 million per annum or not? Are you having your ask amount between less than maybe this amount? Are you in this sector? If you are meeting all these conditions, then we are our fund is here to support you. So every VC fund, it is very, very important question that you have asked. I am seeing you were sending your pitches to 100 investors, but that is not useful at all. You have to understand first the investor, what is his objective, whether your business is catering to what his pre-requirement is. If those conditions are not met, you're sending your excellent presentation and your excellent business idea is also not going to work out. So you have to first understand that who are the investors who will fall in your category, who are going to be applicable for your business, and then only to those you have to pitch.
One more point.
I hope I answered. Yeah.
Yeah. No, there are one more point. See, one is the return on investment. That is normal the idea or objective of the investor, because he's having funds, he's putting the funds, so he's expecting.
Of course.
But as you said, there is a gestation period, there is a time gap, 2 years, 3 years timeline to get the startups up to the level. So is it there are investors who are just looking from the valuation point of view only, I will get the valuation and exit?
No, they look from the return point of view also.
Okay. So both things are there in the mind.
Please understand, Unmesh, if you have returns or if your investment is going to get returns only, then your valuation is going to drive you, right?
Yes.
So there are a lot of funds who are investors who are for a very long-term vision committed to you. They are not looking at quickly gaining valuation and exiting the business. They are here to support your business to get it to another level. So there are a lot of passionate startup entrepreneurs who are not, who really are interested in getting their business to a next level rather than getting into a valuation game. So there are investors to support that. And of course, at that time, ROI is in picture of the returns that they will get from these investments. They will wait for a particular traction to reach the company to reach to a next level. And then they will kind of look at an exit option.
See, one more thing I was seeing, after the startups, we have a lot of entrepreneurs coming up, and the ideas definitely are very lucrative in a way. The issue is that today I was seeing, when I was talking to people, the mindset is changing. See, conceptually, idea is good, but the model, sustainability, long-term deliverable or scalability, all these issues are also important from the business point of view.
Very
now,
important.
what I've seen, they are talking to me, 2-3 साल में इसका valuation बढ़ जाएगा, we'll just sell it at a high valuation, we'll exit, something like that. I think these objectives of the entrepreneurs of the startups may not be the real one, because unless there is a business model, sustainable business model, profitable business model, people won't invest just for the sake of valuation purpose.
I agree with you completely. Unmesh ji. What you said was very, very correct. Scalability, sustainability is very, very important.
Yes.
If your business model, you're not able to explain as I told you, you need to explain your business model in a very pictorial way of very simple, what you want to address, what is your target addressable market, and how much is it going to generate to you, where your terms of top line it's going to get you.
Okay. And normally, how much period they wait for the returns?
Good numbers.
the investors wait for the return? Because see, initially when we see the gross margin may be definitely there, but net margin normally not achieved at least for further 3 years. Normally thumb rule at least 1000 दिन तो किसी को profit किसी business में होता नहीं है. So normally 3 years timeline is minimum to get net profitability.
And investors know about it when they are investing.
Okay,
they
so
have a very long-term vision.
They have long-term vision.
Yeah, they definitely have long-term vision.
Okay, and one
But angel investors may want to exit maybe after some time, but the VC investors have a long-term vision.
Okay, and one more important question: see, we have a number of we come across number of startups and all these things. Now there is a set of investors at one hand, there is a set of the startups at one hand. What is the bridging point? How is there any platform where we can come bring them together, or where is the database where we can talk to them?
There are several there are platforms now set up for getting this automated. So there are online tech platforms available whereby you list your company, you write down the requirements of what your whatever data they are asking, and that platform investors are also logging in.
Okay.
So then you get the kind of traction. That kind of tech companies have already come in place.
Okay. So they will have direct
that
interaction.
space is also evaluating. Yes. And then you have to identify a right investment banker. That's very important.
But what
so
is
the investment banker is one who then connects you with the investors.
Okay. But what is the reliability of this database, or what are the platforms? Because there is always a concern with the startup कि मेरा idea कोई चोरी करके लेके जाएगा. That is the
correct.
They don't want to share all this in open platform. So they are very selective in discussing the ideas or talking to, and immediately the implication may happen differently.
So what happens is, Umesh, when these startups, when these tech platforms also ask you data, they do not ask you about your business model in detail. They ask you how much money, who is the promoter, how much money, what's your company, so basic details.
Basic details.
So your investor pitch is going to be the main communication main communication. Okay, your investor pitch is going to be your communication to your investor. So this platform asks that who is the promoter, what are the co-founders, what's your your website, and how much money are you planning to raise, and which business you are into. That much information. So once if the investor is interested that okay, this pharma space I am interested, what is the tech pharma that they have come up with, then they will approach you, and then you have to set up a separate meeting with them, maybe a Google Meet or something, and then present your pitch ideas.
Okay.
So then you know that you are aware, and then the investor will also send his credentials that we are an investment fund, we are into this business since a long, this is our profile. And generally, you would also find them on internet space, right? You will be aware about their history and all, you can find out. So they find out about you, you find out about them. You have a Google Meet, and then that's where you will have to present your business ideas, what you are saying. So you know that out of whatever people who have seen my requirement needs, only 4 people have come ahead, and they are my investors who are my target investors.
Okay. And one fundamental question, see, we have seen the traditional business over a period of decades. Okay.
Yes.
This is a 360-degree change in the entire business processes, or rather we can say startups and all these things. So from the large scale perspective, do you really feel that this model is going to be long lost? Or because see, computer generation aa gaye, T4 computers aa gaye, everyone changing, and there are waves are coming, waves are going. So is it something like the wave, startup waves comes and it will again go and something different happen, or jo old models of business hai, wo rahega hi aise? What is your vision on this thing?
Unmesh ji, you have asked because we have seen that ticket also, and we have seen this era also. So
we are blessed actually for both the things.
Best of both we have seen. So I do understand, and sometimes, for me, taking a printout is very important, but then somebody explains me, why you want to print out? I said, no, but it's a legal document. I want to print out. I want to make my notes. But you can make the notes online also. What I'm trying to say is that the way right now digitalization has taken up our entire sea change, okay? And the way we are seeing a complete transformation in the way the businesses are operating, this change is definitely the one which is going to stay.
Okay.
And your old traditional methods, because we have to understand that who are going to be our customers in the future? The young generation.
Young generation.
Has the young generation seen the old style of working? Are they going to work the same style? Okay.
Yes.
Today, they don't want to go to a restaurant. They want to order online.
Yes.
Today, they don't want to go shopping like how we went for days and days before Diwali. They don't want to do it. They all want, online, so much options are available. Here, click, 10 clicks done, 10 parcels came. So what I'm trying to tell you is that the era where, the mindset, what's the future is the young generation now. They are going to be the future. And they are the ones who are in millennium. They are millennium generation.
Yes.
Okay, they believe in fast things, fast access, easy access. Okay, they don't want to do hard work at all. They want everything at the tip of their fingers. So we have to understand this target audience who is going to be there for the future. So whether you are in jewelry business, whether you are in banking business, whether you are in whatever business, textile business, what's going to be your future customer? Who is going to be and how their mindset works. They want dental treatment also at home, quick, convenient, at that time, appointment, online, everything is very quick. So all healthcare, everything has to change. Everything is more tech-based, where the millennium is more savvy. Today, you ask a 10-year-old child, he will tell you 1, 2, 3 things like this available, this in Google, this smartphone.
Definitely.
So the information, the speed of information that they are getting is extremely high. For us, we attend classes, we get information, we have studied in that way. But what information they get in 1 hour of Google surfing can be far beyond what we spend in days and days.
Yes.
So they are way ahead. They want new technology to be adapted. So if the businesses do not understand, do not adopt this kind of change, they will be very soon left behind, because all customers will be then millennium customers who will not find their business relevant.
Really? Oh,
I hope I answered your question.
Yeah, absolutely. We have to see the end users ultimately, the customers.
Yes, ultimately, why
their
we are
mindset
making
is
business.
different. So definitely the business will run in that direction. What customer expects.
So who is going to use our services? We have to see that customers, right? So today, when Byju's says, suppose if they are wanting to know who is their addressable market, how they will get the customers, how they will know when they want to do their future projections, what assumptions they will take, what is the birth rate.
Yes.
What's the birth rate in the future? So how many new people are going to get, customers are going to get generated? Okay, people who are in the 6 years of age will, till they are reaching 15 years, they'll continue to be their customers. But the new customers will be the one who are now born and will join the race. So these are the kind of, assumptions that one does mathematically to understand what kind of scalability is there in future also for them.
Yes. Excellently. Thank you very much. Very nice.
Thank you. Thank you. So Shiv Kumar, you are attending? I'm seeing, okay. Really nice to see you.
Attending, but I missed some first 1 hour. I have an interesting session. Very good.
Thank you. Thank you, Shiv Kumar. And thank you so much for attending. I'm feeling quite encouraged.
Yeah. It is good. I want to understand one question, actually. How we attract the PE people when the bottom line is negative and the top line is good?
$1 million question, Shiv Kumar. A lot of startups are struggling on that. So that is the reason why we are saying that A is that you need to, when you are, a very, very simple and base level question is there are lots of do's and don'ts. But what I'm saying is you need to separate your marketing costs. Separate your costs which are going to benefit you over a period of time, like your tech costs, your marketing costs. And then you need to see whether your gross margins are profitable or not, and show that picture to the investor.
Yes.
You have to show them. Yeah.
Right. And the marketing cost is one thing, and acquisition costs are something like that. It is more than the marketing cost. We are unable to bifurcate the things and all. These type of difficulties, how we are able to attract the investors.
Okay. So what is 1 crore. You are not able to identify, but in that 1 crore, how many new customers you have got in that year? That statistics, at least the actual customers we have, right?
Yeah.
So when you have actual customers, you divide the marketing cost, divide by the customers. So you will at least get a very high level of cost of acquisition. And you believe that your brand is over the years getting developed. You can put a percentage. You are not able to bifurcate, it's okay. Put a percentage that out of this 10 to 20% is going on building my brand.
Yes.
Okay, it may not be visible in terms of actual breakup, but I'm building my brand on a year-on-year basis.
Okay.
So you put a percentage to it, Shivkumar, and the remaining you give as a cost of acquisition per user. And just see if your gross margins are going positive.
Yes, gross margins are 100% positive and it is very good.
And also second thing is, Shivkumar, on the little more detailed ways that you need to very, very revolutionary wise think that how your marketing and other spends could be changed.
Yes.
You know, your operating model can be completely changed. I'm seeing so much of common facilities getting utilized. You know, people not developing their back-end operations. Even manufacturing companies are getting tied up with third-party, partners who are having their own manufacturing unit. So they do not have to start that from scratch, and they only pay what they are buying. So a lot of things are there, Shivkumar, where you can revolutionarily think about a lot of things. But on a outset of your question, yes, the presentation will make a very big difference to the investor. Okay. How you're conveying your idea, how you're showing your gross margin positive, show your brand acquisition cost, and show your marketing spend separate, and say that your marketing cost right now will give the lifetime value to your customers. He will be my lifetime customer at least for 3 years, 4 years. So over that 3-4 years, I will generate a positive ROI from him.
We have, we have some advertisement, Parex advertisement is there, na? Mummy, daughter, granddaughter is using the Nero's brands and all. Like that, yes. We have a track record. That is not the startup company for us. Actually, we want to understand. Actually, this section is good, important to me. I missed out this first 45 minutes of this section. I hope you are recorded that section. Please share personally or in the group. It is helpful to me personally, definitely. I will get it.
Definitely, Shivkumar. Definitely.
Definitely. Good session. Very good session.
Thank you, Shivkumar. And I see Praveen has also joined the session.
Yeah. I think it's very insightful session. So I have something also, but I keep it aside, and I was just listening to your thing, which is an opportunity for me to know about you and as well as the profession and the knowledge which you are sharing. It's really insightful session. What is happening?
Thank you, Praveen. Thank you for attending and giving me encouragement.
Yeah, sure. No, you are given. You actually, it is not. You are sharing your knowledge to the society, and you are building the society with your knowledge.
Thank you, Praveen.
Yeah.
Yes, Manoj.
Well, that's what think tank is about: sharing knowledge and sharing experiences.
Yes, yes.
There is a Krishnan has raised his hands for a long time. Let him finish. We have lots of issues. Krishnan.
Yeah,
Krishnan, hi, Krishnan.
Hey, hi, Falguni. Very good, superb session. Okay, you kept it very short, sweet, simple. Now, just to piggyback what Mr. You and Umesh Ji were asking, and
yes.
Then I would add my one simple question.
Yes.
For example, today's young generation, our fathers studied in an age when schools didn't have fans. We studied wherein schools have fans. My 10-year-old son is studying in a school which has an AC classroom.
Yes.
Okay, so that is very young. True. That speaks about the difference, the mindset. Okay,
yes.
So my question is now today with abundance of opportunities, probably getting a fund is easy. Maybe not now, maybe next time you can throw on the challenges post fundraising, because when somebody is putting money, he is going to squeeze the last drop out of you. So maybe on the report, and because of these, it is possible that you lose focus on your business. You are more dependent on the operations or reports. Okay, so ऐसा भी हो सकता है. I'm sure.
I have seen companies struggling, and what happens is that there are a lot of earlier you were doing your business, you didn't have to explain a lot of things. Now you need to share your MISs with people. All the other various people will have various requirements. Even the investors have their own requirements of putting up their performance of how various businesses are doing. So your MIS will play a very, very important role.
Correct. And also because it is possible that because of this MIS, you lose focus on your core business strength. Possible. So maybe not now, maybe Manoj ji, you all can discuss and focus on Krishnan. Those challenges also.
Correct. I agree. I would be very glad to share.
Yeah, because that will make the session more comprehensive, of course.
Very important.
80% is what you said, but 20% what we just spoke regarding the MIS, the reports, etc. That is also equally important.
Very
so maybe
important.
Not now. That's my simple thought. And super. Keep it up.
Thank you, Krishnan, for your encouragement.
There are some important questions on financial projections. Can you take that up on the chat box?
Acha, okay. Sorry, I didn't see the chat box. Okay, give me 1 second. Okay, sorry, I did not see the chat box at all. Okay.
There is some important question on financial projections.
Okay. 1 second. I will just. At an idea level or a very initial level, what is the extent of dealing in financial projections that is generally expected by initial investors? Initially, the investors are interested in financials. What is your top line? I said unit metrics. Unit metrics is important, that what are the number of transactions that you're doing, each maybe product wise or maybe your subdivision wise, B2B business, B2C business, hybrid. If you are dealing in 3 products, maybe product wise bifurcation of those quantity details, and how much is the gross revenues that you're doing in all these 3 businesses, and average ticket size that you're deriving. So one will be your unit metrics. In financials, it should be only 1 slide, which should explain that what is your current that you are reaching, what are your past you have reached, and maybe extended to maybe 4 or 5 projections or 4-5 years ahead. So what you have to include is your top line, your direct costs, your gross margins. Your gross margins need to come out very clearly. Then starts your fixed assets, maybe marketing, your personnel cost, your admin and HO cost, whatever your other costs are. So there will be only 4 to 5 heads that will come in your downline, and then it will be profit before tax and depreciation. It will be depreciation and it will be EBITDA. So this is a one-liner financial that they are expecting right now from you. You do not have to go into details of your assumption sheets and lots of other things. If they are interested, then they will come back to that. So financials have to be very short, very sweet. They should understand that if I'm putting 10 crore, how much of ROI I'm going to generate. If you are saying that this 10 crore is going to reach me from 1 crore business to 15 crore business, they will understand this ROI will multiply into what for them. So keep it very simple. That's what I want to see.
Nitin Khandkar, you are there. You had something?
They are saying that mostly provide broad assumptions. Also, some are very reluctant to share their research material with consultants, which help yet financial projections. In such cases, as a professional, to what extent we support in financial projections?
Yeah, one thing, these are very nice questions. Khadija, you are welcome to put on a video and ask also. That will help the better context. Of course, your question will be answered. Would you like to, Khadija?
Oh, Khadija, you are there. Hi, welcome to the session.
Put on a video. And you can interact also.
Yes, I can hear you, Khadija. Thank you for attending my session.
Thanks. Can you see?
I cannot see you, but
yeah, we can see you now.
Yeah. So, how are you, Falguni?
I'm fine. Nice to hear from you, Khadija.
Hi. It was a very good session.
Oh, thank you so much.
And the best part is that you're sharing the knowledge with everyone. So
yes,
this is the question which I was asking. Actually, we do come across some of very young entrepreneurs. They're just 23, 24 years. So they may have very great ideas and they have knowledge about the business. I mean to say, especially in the IT field and the fintech. But the problem is, and they ask us to assist in financial projections. But the problem that I've seen is that they give you a very vague idea. Okay, this is my 5% it will increase. So then when you ask for how they have you were speaking about the TAM, etc. This kind of information they are not able to share. So we do help them in because we are a finance people, and it's just Excel working in that case. But we ourselves as finance professionals are not very convinced about what we're doing. So I am not sure as a professional to what extent can we should we really get into such kind of projections.
See, Khadija, I understand, but what you have to make very clear to the client is that you have to sign an NDA with them. And NDA is a non-disclosure agreement, which everybody believes that if anything of their, and then if the business is so much into some kind of an innovation where the customer is feeling or the client is feeling, the entrepreneur is feeling that my innovation should not go outside. You can assign a conflicting clause also with him that you will not deal with customers of the similar industry for 1 year.
Okay, so, so that you don't share the
innovation doesn't maybe similar clients. So once you have an NDA in place, then I would suggest that you have to explain your client, the startup entrepreneur, especially the new generation, that if they do not share with the doctor, then you will never get the cure, right? The medicine will not be prescribed correctly. So you can only do 100% of your job efficiently only if you get all the details. So I guess that NDA should and non-compete clause can make the things very clear if you clearly explain them that you are also legally bound.
But also one thing I've noticed that some of these people I interacted with are they actually don't have also, they don't do that kind of research. And because you were speaking of quite some, I have seen the metrics PPT and the kind of information and the value for life and all those things. I don't think so they're aware of such concepts, especially the younger ones or people who are moving from some traditional businesses. Like I have met people who have done proprietorship business and now they are moving into, let's say, e-commerce and they want to do, but they may not have such kind of information.
Knowledge.
But but still they expect us to help them in financial modeling. So they do give us a broad thing. Okay, you take annual 20% revenue growth, etc., etc. So is it okay? We do that for them, but then we do educate also. But they don't have the funds right now to invest in such kind of data research. They don't want to take. They start with their own funds of, let's say, 25-50 lakhs. For the initial few months. So how do we balance this? So when we support such kind of entrepreneurs?
Yeah, Khadija, what I would say is that all these family enterprises, the traditional, people who are doing businesses, proprietors, who are now wanting to, get into a new age startups or maybe, change their business models and all that. Many times they would not understand these kind of concepts. That's why very basic I have made today's presentation on what they should look at. And secondly is that, when you want to help them doing the financial modeling and all that, you need to prepare a proper questionnaire of the assumptions that you want. What is the unit matrix? So you need to understand their business and you need to come up with a set of questions. That set of questions will be very helpful. Only then when you receive answers, when they will think when they want to answer that, they have to, then think about that question and answer you. So once you have all the answers, you prepare a financial model and tell them, is this what you are thinking? Because that is where your skill set will come out. Because we cannot expect the proprietors today to know everything of this. If they knew so much of modern things of right now, what is an ROA, return on advertisement, this, that. So then, professionals like me and you weren't required, right? So we have to come up with right set of questionnaire. We have to make a very comprehensive questionnaire, understanding the business needs, and each questionnaire will be very different from the other. So if I'm going to meet an entrepreneur who is into a grocery business and wants to convert it digitally, if I'm meeting somebody from a era who is into, agri-tech business, my questionnaire will be very different, very personalized. And I would ask him real questions of how I would do a unit matrix for him. So it may be a very basic questions also. I'm not saying a very high tech, but very, very basic questions also I will ask him. And then once he answers them, say suppose if he says that I cannot answer these 4 questions, you further break it up into few discussion modes and try to get the answer from him. There are possibilities that you may only have to draft certain answers for them.
Yes, yeah, basically
They will say that, you know,
lead them into it.
Yes. You break it up into simple forms and try to get into a conversation with them and then answer their questionnaire. And that questionnaire will help you then to make those unit metrics much closer to their needs.
Okay. Great, Falguni. Thanks a lot. Thank you.
Thank you for attending, Khadija. It was a great encouragement.
Thanks. I'll attend future sessions also. I really learned a lot about it. Something new, completely different from our routine audit and accounts. And that
you will always get something new. Keep on joining all the sessions, especially for the series. Nitin and Nilanjan.
Yeah, Manoj, maybe I can go next. Right. Hi, Falguni. Thank you for sharing your thoughts on this lovely topic of startups.
Thank you.
I come from a finance and auditing background, right? So maybe I would like to have your thoughts, especially on the, there is always a thought or a talk about making life simpler or ease of doing business, as we call it, right? Ease of corporate living and all that. So what had been your experience from a regulatory framework perspective? Right. I know the government has been striving to make various amendments to ease the incubation phase of any startup. Right. So they have made changes to the listing regulations. They have brought into the novel concepts like innovators growth platform and all those things. But is it, in your experience, is only something which is written down in a piece of paper, or you have seen people actually getting benefited from all these supportive policy making of the government?
Very important question. Sorry, I missed your name. I'm not able to see who is speaking. So
I'm sorry, I'm not able to put on my video because I am on the road right now.
That's okay.
Well, my name is Nilanjan. My name is Nilanjan.
Okay, Nilanjan.
Yeah.
Nilanjan, very good morning. Thank you for attending this session. And so let me put it in this way that yes, we are seeing actual reforms also happening. A government actually working towards, getting to Atmanirbhar Bharat, whatever they are wanting to say. Maybe not in that much form and gauge what they are propaganding, but yes, alternative investment fund, if you would say, which is, going away with a lot of needs on, earlier the funding requirement was going through so much of stringent. Today, you have an alternate investment fund set up by the government. You don't have to take much permissions. You are able to, your compliances are very eased out. So you can say that is giving a big funding to the startup companies. Alternate investment funds are seeing a very big wave. Such similar kind of lot of initiatives have been taken by government. Lot of benefits in terms of exemptions have also been promoted by the government for startups, and funding also at a very premature a business which is at a very startup at a very young stage has also been promoted by the banks. So I feel that yes, the reforms have happened, and we are still hoping to see more reforms and the due importance that India should actually give for Atmanirbhar, so that we do not depend on, our exports, our imports from China were at 23%. So we do not, I think that there is still opportunity a lot for the government to do, is in all those sectors, give a lot of, beef up and leeway and encouragement to the young entrepreneurs, so that we don't have to import from China. We don't have to import from other countries. And in that way, we really became more self-sustainable. So my answer is mixed. It is definitely, we are seeing reforms. It's not only on paper. There are definitely a lot of government initiatives, and we are hoping to see more.
Sure. And maybe on the next perspective of yours, I have always I have also seen things when they go sour with the founder and maybe the so-called sole financer or the PE funds and all those things. We heard certain names recently, right, when one of the founder member posed some allegations on the board, right? So in your experience, is not meeting those benchmarking threshold, is that the cause of a concern, or do you also feel that the startups are also equally affected by various financial irregularities, or maybe the culture of that organization is also of a questionable nature?
Correct. So I would, Nilanjan, put this in this way that when you are doing your own business, it's a very different game.
Yeah.
But when you are asking for funds from an investor, you have to be coming out of that mindset कि मैं ये धंधे का मालिक हूँ.
Yeah.
You have to come out with that mindset, and you have to go to corporate governance. See, that is where the professionals like me and you will put a very big difference, because all these family offices, how a corporate governance works, how a board works, how is a board structure, what are independent thinking. A father and son also, they may have delegation issues. Father will think X, son will think Y. So there has to be, even in the family offices, I have seen that, we have to set up a proper board meeting kind of agenda where the chairman will also present, the son will also present. There will be other leaders also who will present, and a unanimous decision will be arrived at, taking various stands into picture. So when you are asking for funds, I think that a big mindset that the startups and entrepreneurs will have to keep is that now we have to maintain all the corporate governance. And I'm not doubting their intentions at all. Their intentions may be very good, but the style of working, what you're saying, that clashes are coming, is because they are wanting to continue working in an environment where they are all the decision makers. But one moment you take investing funds, then the investors also have a say in your business. Okay, their vision and your vision has to be very compassionate. Like I know business where, the family owners were so passionate about their business. So getting an investor who would want to very quickly get valuations and come out may not be the right type of investors for them.
Right.
We will get investors who are for a long term with them, with their vision, who are, say, suppose if I have seen a lot of entrepreneurs who are saying that, no, we want to run this business only for years. We only want very small stake to be given to outsiders. But at the same time, whether those outsiders are also buying in your leadership, are they really feeling that you will be able to take this company to the 1,000 crore also? You can be only the chairman. So that's a question. And that mindset has to be kept very open. Corporate governance has to be followed. One needs to be very, very clear with the funds, the transparency, how you are maintaining. Irregularities have to be avoided. Infrastructure cost has to be in that area. One needs to be very, very sharp on, you're getting independent board directors, you're getting investors on board. You have to be very sure on whether the irregularities are not met. So I would say that the efforts would be both from the investors' point of view also to get these businesses to a, kind of experience what they have in managing these kind of governance issues, as well as to the companies also to have that mindset to change. Once both of them have that same mindset, then these kind of things will not come out. And, we would not have this kind of soreness in the deals, post investments also. I hope you agree with me.
Yeah, I do agree. I think ultimately you have to, both
strike a balance.
Yeah. So I don't
strike
want to
a balance in, managing your business as well as managing the corporate governance, because now you have somebody else also who is viewing your business, who has a stake in your business. It may not be your, percentage majority, but having a stake itself shows that he's also the owner, right?
Yeah. So if I have to put it in a lighter note, in Indian marriages, when we say that we don't only marry the girl or the boy, we get into the entire family.
Yes.
Right. So ultimately both the families have to work together to make this new bride and groom work together.
Correct. And the investors are also asking such questions. They are also wanting to understand that the promoters have a long-term vision. What is their vision? Whether, what is the stake? So they are also very blunt.
Yeah.
Because ultimately they also have to deliver for their funds, right?
Yeah. And maybe the last question, if I can.
Please.
Yeah. So we all see this, the new term that we call it the Great Resignation, right? The phase that we all are seeing, right? The attrition levels are all-time high across industry.
Yes.
IT has been one of the behemoths where people are looking up to that space. So in your experience, has the startups space in general have been able to attract newer and efficient talent, or they still are not untouched by this by this great resignation?
Can you repeat your question? I lost your voice in between sometime. I'm so sorry about it.
No, that's fine. That's fine. So what I was trying to ask is that we are seeing a great level of attrition, right, across sectors, right?
Yes.
People are looking for, if I can use the word, greener pastures, right? They're trying to look at for more areas where there is a more work-life balance, right?
Correct.
Where we're able to spend some time with my native place, my families, and all those things.
Yes.
So what I can read from papers is that IT is one industry which is actually benefiting from these mass resignations. So in this startup phase in general, right, do you believe or do you feel that those industries are also getting affected by these resignations, or they have been successful in attracting talent?
No, definitely they are facing challenges, Nilanjan, to be very precise and clear. The heat is felt because IT people are more in demand. There are various specialists, full stack people who are aware about full stack, people who are aware about various. So, there's an attrition, and companies are coming up with a lot of, that is where, Nilanjan, I would suggest that ESOPs play a very major role. At least your top talent, you are able to, see a certain level of attrition you anyways cannot, avoid. But definitely they are feeling the heat in expanding their business by getting, retaining the right kind of talent with them. So I think ESOP will play a very important role. Once your leaders are there as a long-term vision with you, then your team can pretty much get managed even with a attrition rate which is a little higher than the other industries. So that is how I would put it.
Okay, sure. Thank you, Falguni, once more. Thank you.
Yeah, and also flexible working hours, because IT, I have seen companies, many startups giving only the IT team leverage to work from their home, work from anywhere, and get their things moving and up. For them, their successful business achievement. I mean, if their targets are achieved, the IT people are given the flexibility to work from home. So that also, one of the way to lure your employees to stay around with you for a longer time.
Sure. Thank you, Falguni.
Yeah, welcome.
Nitin, you had something to share?
Yeah, this Krishnan, I would definitely be mentioning to you about the debt fundraising platforms. Definitely I will talk about them in my next session. Yeah, please, Nitin ji.
Falguni, excellent session. A lot of practical on the ground insights, which are very useful for startup founders. So thanks for that.
Nitin ji. Thank you for encouragement.
Sure. So I have just a general question, Falguni.
Yeah.
How does a startup ensure that its pitch is read and reviewed by VCs or angels, which are the target audience, given the fact that these investors literally have thousands of proposals in their mailboxes? I have dealt with a couple of startups. I had sent a pitch to a VC fund, and the response I got is, I got like 800 proposals in the mailbox. And I'm going to require 2 months to revert on your proposal. So would love to hear thoughts on that, Falguni. Thank you.
Nitin ji, first, as I had mentioned to you, that we need to very clearly go to funds who are actually coming in our range, because every fund will have a criteria. They have a criteria that they look up to 1 million investments in a company, who are ask amount is between 1 million to 10 million. Some funds will have an X some funds are saying that we only want B2C, we do not want B2B players. So there are various funds who are having various perspectives. Some are saying we are only into real estate funds. So in real estate also, we are only into retail. I mean, if you want to stay, it's not for commercial use. So various funds, we have to understand, that's number one. Number two is that is the reason why today's session was organized, is why on a very basic concept, pitch is so important, because a pitch is the communication between you and the investor. And what impression first he will get about your business is the first 30 seconds to 1 minute, he will decide whether he wants to invest in your business or not. That kind of short sight you will have. So that is why this deck, that slide, if I don't know anything, give me one slide, it should be able to get my all answers. It is like that. So the impressive deck, I have seen that always gets a favorable at least answer from the investor, that it would want to meet you at least for a Google Meet with your with the startups entrepreneurs, and would want to at least have a conversation to understand the business. Whether they finally invest or not is, of course, a call later on after they see your business. But investor deck is that kind of an opportunity that will finally lead you to the, getting the attention of the investor.
Let me rephrase my question. When I ask you a question, I already implied that, some bit of research has been done into the background of the investor and, what are his sweet spots in terms of.
So what I am saying is, Nitinji, then those funds may not be, those investors may not be the right set of for your business. There are other investors who are really looking out for opportunities in the market right now. I feel that instead of wasting time with some giants who are already overfull on their agenda, we look for investors who have money and are wanting to have lucrative businesses. In fact, they are on a search that please give good businesses who are able to generate money for our customers. So investors are also in an equal need at the moment. So I would suggest that there will be,
yeah, please continue.
I am saying that there will be certain funds you will come across in your journey where they will sound over busy and over committed. So we have to leave them, filter them, and go to clients, investors who are open for investments.
Sure. So as the sense I get is, some startups are more equal than others, as far as getting the right access.
It
and
is
it's already always a question of, having the right advisor who can, direct to the right audience, I guess.
Yeah, that's also there. Definitely, right kind of investment advisors would definitely help you to get the attention, because they are definitely why the investors are so attentive to those advisors, because the advisors understand what the investor needs. So they get very fond in talking with them about the ideas, investments, businesses. So if they take proposal, it's not that the proposal has changed. You and I taking and they taking, it's not the proposal has changed. But when an advisor takes a proposal, they are very sure that certain kind of grilling already has been done. You don't have to go from the basics. I hope, Nitinji, I answered your question.
Yes, you did very much. Thank you, Falguni.
Thank you. Thank you, Nitinji. So thank you everybody for participating in such a, participative manner.
Falguni?
Thank you.
Yeah. Falguni, can you hear me?
Yeah, Manojji.
Yeah. Falguni, suddenly we have seen this month, there have been a lot of shocks on the ground for a lot of startups. We are hearing of employees getting laid off, and the list has been circulating, one company, 1,000 employees, an academy, another one, 624, Vedantu, Cars 24, 600, M-Fine in that healthcare vertical, online consultation, 500, Trail 300, Lido 200, 180, this Fluence, Misho 150, Front Row, MPL, lot of suddenly funds getting dried up. So they are just throwing out employees. What will happen to their ideas and the viability and the break-even rates? How are things on the ground now, based on your experience?
Manojji, see, there has been a lot of acquisitions, consolidation. So we were seeing, the laid-offs can be a part of the consolidation game. Today, we all are aware that, you know, corporate India, the last stage funding is also so much in, you know, right now people are funding in to buy other companies. So when any type of consolidation happens in the company, businesses, we see certain kind of layouts. Plus technology wise also, we are driving at a very high speed. So people are wanting to completely change their business models, make it more competitive, make it more cost effective, make it better margins. So because of that also, you may say a lot of winding ups. Also the startup funds, you know, in a perspective of the global scenario in which we are crisis, you know, the Ukraine war, you can say, or, you know, the global uncertainty that exists right now in the market. Definitely because of that, the investors may be on a little more precautionary way. But investments are happening very, very aggressively. If you can see the number one, the starting of the first half of 22, the numbers are far beyond the 20 numbers. But yes, right now we are seeing a little precautionary by the investors. They want to ensure that whatever they are putting in the businesses are sustainable in the future also. Scalability is very important. That's where I'm saying that your business model needs to be extremely very clear, precise, and scalable, and having very, very revolutionary ideas of how you want to meet the segment and lay down a differentiation. So I would say layoffs are a part of consolidation in the long run. Any corporate India would be facing. But otherwise, Vedantu businesses are also, you know, today doing very excellent. And all the other corporates also, which you said, are all doing very good. In fact, Swiggy has gone into decacorn valuation. So I would say that consolidation is something that would happen always in the industry.
So now very risky to join startups. They make a lot of promises, ESOPs, you know, high salaries, and suddenly get laid off. Some are laid off in 3 months, some are laid off after 1 year. And May is a season of layoffs. Hope 2022 doesn't become a season of layoffs. There's a lot of optimism also you're talking about, right?
Yes. Lot of optimism is there in the market also. And startups also, as I told you, Manoj, startups also, the ones who want to make a difference, ones who have very cautiously thought about their runway, those startups will not have a problem, you know.
Good afternoon, everyone. Dushyant Shah here. Just one, you know, what Manoj said, just to add to that. Now, suddenly we hear about investment winter, they call it. You know, that suddenly all these PE and VC funds, you know, they are more cautious about investment. And looks like that they have changed their criteria from solely on revenue growth to some kind of profitability. So that's what I think is suddenly seems that the funds have, you know, slowed down on investing.
So I mentioned earlier in my slides that funds are moving towards profitability. You may not see the rally like what you have seen for maybe Ola and earlier other companies who were bleeding. They are definitely seeing profitability also as one of the very main criteria to select and make a differentiation. And at least on the gross margin levels, you need to be highly profitable. And then how you will scale it up and meet the EBITDA break-even also can be defined. So your observation is very right, Dushyant ji.
Yeah, thanks, Falguni.
Yeah.
Now, we have seen there are lots of angels in the startup ecosystem.
Yes, 1,000 plus, yeah.
And
active angels, yeah.
Yes. And the people are saying you should fill up the tank with sharks. Also, sharks are essentials. So what is your experience about these angels and sharks? What type of skills are required? And do we need the sharks in the system? And what is the role they play?
Manoj, very relevant question. See, what I have really practical experience. What you know, I don't know if you guys will agree with me, but my practical experience has been that if you have only an idea, and you want to sell it, then your family, your friends, all those who are high net worth individuals around you who have been known you since years will only invest. because it's very difficult for you only on an idea stage that you have nothing but a piece of paper and telling them that this is what my idea is and I want so angel investors, who are these angel investors? They are investors who are these high net worth individuals who would invest in your business for a rate of maybe equity ownership in your business. And so yes, there are angel investors who are looking to invest in other businesses also, like maybe not your family friends, but other investors. So what would know you is the scalability of your business, what is the scalability of your business, what is your business model, whether it will gain revenue for them in the future, how will they be able to have an exit option, what kind of exit option are you planning for them, how much kind of your own investment are you putting in this, or it's all that they have to put in, they you don't have your own stakes in place. So they will be very, very equally interested in a lot of other things. So if they are putting 5 rupees, they want you to also have your 10 rupees inside already. So this is all what the angel investors for family and friend. These are the things and questions that they would have in mind.
And next is a very important, lots of big business and industrial houses or their board members, either as a corporate or in their individual capacity, have taken a lot of interest in startups. This includes the Tata Group, Ratan Tata, also Infosys or Nandan Nilekani, Narayan Murthy, and Reliance Jio itself is talking about making a big difference in the startup space. Adani's and all. What difference you feel is they are able to make a difference to the startup ecosystem? Generally, business houses are known for their traditional mindset, and startups, is a new age mindset which has to be totally unleashed and given freedom. And what is happening on the ground, and what difference you feel they are making, or some changes you would expect?
See, Manoj, I definitely know that these millennium kids are very different and the startup entrepreneur mindset is very different. But when we are talking about these kind of angel investors who are industry stalwarts, who have passed through the, the highs and the lows of the industry, who have passed through the grilling of the business world, how the, top revenue is generated, what are the challenges that the one is facing. So I believe that they bring in a lot of wisdom with them and a lot of experience on table. And the young entrepreneurs, yes, at the same time, when they have to be given a lot of freedom and they cannot be, on a conventional basis, like how other businesses and they may have operated in their own industrial houses. But at the same time, it has to be a big mixed balance of experience. One says that, one needs to experience everything to understand. But I would say that now the new mantra of this millennium is, you need not experience everything at a cost. You can buy somebody's experience and, grill on that scalability and benefit out of it. So I think that the new millennium is very open to that, and they understand somebody who wants to really get their business to the next level have to have this mantra that based on your experience, I need not spend that much money what you spend in your past, but I would learn from your experiences and scale up to high businesses. So I would say that this is a mix of it. And the industry stalwarts are also understanding that, today's new age millenniums need to give that kind of freedom. So they will never interfere in your, your business ideas. But at the same time, they will bring in a lot of experience, which is very helpful. I hope you agree with me, Manoj.
Right, good. Now, we talked about, this is a very important topic selected for the day. Very, very important. That's why we are giving enough time to do it justice. The first meeting, actually, when it happens, what in your experience you would suggest should be the duration kept to?
You mean to say the physical meetings, like on site?
Yeah, the first meeting, whichever is a meeting desired by the investor.
Oh, okay.
On site or outside, international meeting, it may be, it may be online, or the local meeting, it could happen in a hotel or wherever, mutually
So
suggestion and office.
Manojji, what happens is that it depends upon what, sorry. Manojji, it depends upon what kind of stage you are in to get that meeting. Say, suppose if an investor
First stage meeting.
Means they have never seen your investor deck or nothing, then you need to at least keep a 2 hours.
You
at least need to keep a 2 hour slide.
2 hours.
2 hours.
So investor has to be ready to give in 2 hours. Generally, they save half an hour or 40 minutes.
So I was just coming to that only. That you need to sell your idea. That's why we are just keeping the investor deck for 15 slides, right? So you can finish the meeting in half an hour and make him buy the idea. But you are saying if he's coming from outstation, he's coming here and he's going to meet you in a hotel, then in a half an hour, if he's buying your idea, maybe he will call you the next day if he's staying back. Or maybe he will tell you that let the meeting get extended. But in the first half an hour, you have to sell your idea to him. You have to understand you're going for a pitch where you want to get money from him. It's a selling pitch. So you have to be very crisp, very 12 to 15 slides, and you have to finish. You have to get him to the idea of buying your business. He needs to understand as a layman what your business model is all about. So this 12 to 15 slides, what I have presented is only what we have to present to him. And of course, you can keep some few numbers here, with you, if in case he asks you. So I think in half an hour, you can finish off the first meeting.
Your slides have been quite exhaustive. And if there is an interaction with the investor who is actually putting his money where the mouth is, it would require certainly more than 2 hours.
Yeah, but initially for him to grasp the idea, what the investors initially look at when they look at a pitches, they would not get in. The one slide will explain him all the data points that he wants. See, when a person has to ask you a lot of questions, when he doesn't have the data point, when he sees that there is a cost of acquisition, when there is an LTV, there is a clearly mentioned what are your margins, what are this. So everything is there on the slide, right? So it's a quick glance through for him to understand he a decision whether he wants to go ahead with you or not. So that decision making may not have too much of interaction would also be there, but it will be to the extent where he will take that decision. And if he's interested, then he will say that let's fix another meeting for more detailed discussion.
So
then he will go into your assumptions.
Yeah, carry on. Yeah.
Sorry, then he will go into your assumptions in detail. What kind of assumptions have you, your target audience also, what kind of assumptions have you, addressable target audience is there? What other assumptions have you made? How have you, defined your sales numbers? A lot of other questions will come later on.
So what we are seeing is the entrepreneur or the founders, co-founders who are doing for the first meeting should be thoroughly prepared for a scheduled meeting of at least 2 hours. They should be thoroughly prepared.
Yes,
but
absolutely.
When they do the meeting, the first half an hour are very critical to keep the investor interested and engaged in going ahead for a longer time.
Not only interested and engaged, but sold out the idea. He's already sold out. In the first half an hour, the idea has to be sold out to him.
First half an hour, very, very clearly, they should engage the investor and sell out.
And
simple.
Also, what happens is looking at the 15 slides, he may not have gone into each and every number in detail as of now, but he understands that this company or this promoter or this startup entrepreneur has a mindset of doing a business. He knows and understands what are the grills of it. So your investor pitch will explain for itself.
So, and what about your experience in negotiating? Ultimately, you said in the first meeting, there should be ASK very clearly, right? That is essential. Ask has to be there. So at what stage the negotiation comes in which meeting?
See, what happens is that you can always be ready with your numbers. You know what you have spent already in the business. You may have a bootstrapped company till now, what money you have already invested, what kind of valuation are you looking at based on, you may have some mathematics of whether you want to go valuation top line wise or, how you want to go about. So you will have certain kind of numbers in your mind. If you want to gauge the investor and take a time from him for valuation, there is no hurry in telling him your valuation upfront. It's okay. If he's interested in your idea, if he has bought, and you can in the next meeting then present to him that this is what I'm proposing. So do not make a hurry if you're not sure. But yes, if you have to keep your maths very clear, you have to do the working, what value you present. And if you can convey to him that this is the total valuation that I am looking at, and this much is the percentage that I want to, this funds that I will get in will dilute my position from X percentage to Y percentage. Also, always keep your cap table ready, because cap table is something that they are very much interested in case if they have bought your idea, they would want to know who is on the cap table. Whether there are other investors already on the cap table, whether it's a family owned, whether your relatives are owning, some part of the equity or not. So cap table becomes a very important data point for them. So you have to be very handy with your cap tables.
What is the general size of investments you have been dealing, and what has been a strike rate so far?
The investments that we deal with is right from 10 lakh rupees to right now we have raised for 100 crore companies, 100 crore also, and IPOs also, company going for successful IPOs on the stock exchange. So, the strike rate, you would say in the investor, this would not be more than 15%.
I'm talking about success rate.
Success rate would be more than 85%. More than
85%.
Yeah.
And 15% is what, the success rate of the business?
15% what I was actually understood some other question. So 85% is something we would look at. I was saying in terms of 15% for low investments and IPOs. IPOs will be 15% of the total kitty.
Okay. The composition of the thing.
IPOs will be 15%. Who are going for IPOs, because some companies want to go for IPOs. They do not want to raise further more equity capital.
Certainly. We had a series of sessions on IPOs, and we'll continue because more and more SMEs are looking at listing, and ultimately listing gives the maximum value creation also, particularly for exits. It gives you the flexibility also.
And specifically family offices where they are doing business and which is profit generating for them, they would rather go for debt options and first scale up their business, and then they would directly like to go for IPO.
And from your experience, how many of the startups are successful? Because Indian entrepreneurs are very conservative. They generally don't like to go for business unless they have the business blood in them. And a lot of people now being educated, even IIT, IIMs, they prefer now to try their hand at this startup game. But mindset is conservative, and they like to go generally with lots of preparation usually, like we are doing here today. Everything is planned and try to be and practical, go for good success. So in your experience, what is the success rate of startups so far?
Very difficult question to answer, Manoj ji. The success rate of startups will not be very, very encouraging if you see in terms of the statistics, but it's improving on year-on-year basis. Year-on-year basis, see everybody, all the startups, there will be thousands of startup companies, all cannot be unicorns, right? But
we are not talking about unicorns. We are talking about a return which the investor expects. Some expect 30%, some expect 20%, or some even expect failures. There are some people who are trying to scare. They said if you invest in 10 startups, 9 one will be succeeding, but one may become a multi-bagger or 10-bagger. But how many of them fail or go bankrupt from that angle, or how many succeed and remain in the system? May not get 30%, but may get a moderate rate. So how many failures you expect?
Percentage and statistics is very difficult to say, but yes, when an investor is looking at a portfolio of investments, he is doing, maybe say if he's restricting himself to 20 investments, he would assume that at least 1 or 2 or 3 will go for multi-bagger, and the remaining will be in a moderate issue, and there are maybe 20% who will fail. Completely failure, you cannot have to, out of 10, only 1 will go to unicorn and 9 will fail. When we say fail, means 20% will go on to a loss making or shutdown or maybe not there. But the remaining 80% moderate kind of you may not make returns what you have anticipated. Maybe they are still driving through. So, it's a mix of portfolio. When you are actually, it is like your personal investment. When you are investing, gold is the safest. Then you know that equity, out of 10 equity, 1 will get me this. So it is that kind of a risk that you have to take with the startups. But, I think that by now, till now, the investors and all the VCs in the last run from 2021, whatever statistics we are getting, they all have very fabulously performed.
This is interesting. In fact, we got it from the Prime Minister just last week.
Yeah.
Indian startups are much more successful than startups in other countries in the world.
Very true.
So the numbers you are also given are really gladdening. When you talk about 20% may get into failures, but others moderate return, and with good inputs and efficiencies from people like all the people joining here together, that increases the rate of success. And it is not as bad as only one out of 10 will succeed.
No.
Many more succeed.
Correct.
Some go through transitions as Paytm is going about. Paytm also, you talked about break-even rate, but now they said, okay, we will try to achieve break-even much faster because they listen to investors. This is very, very interesting. Excellent session. Santosh is here with us. Santosh, something from you on startups?
So no, Manojji, first of all, apologies to not be able to join in earlier. I think from whatever I heard, I think it was a very insightful, very incisive session. Thanks, Falguni.
Thank you, Santosh.
Startups, just to react, I think obviously, I think last year we had, was it what, 30 odd unicorns from India. And this year, the first few months, I think we have already had some 20 odd unicorns. So obviously, it's looks quite promising. But many educational startups are now making, huge for the wrong reasons, right? Because of sacking people, etc. Bangalore is, in fact, I don't know if Ram Prasad has joined, but for example, many startups in Bangalore have actually, started sacking people. So I think the school from home frenzy has kind of, has ended. But yes, of course.
As I said, Santosh, right now, because of the global crisis and a lot of other things in the parameter and uncertainties that are blooming in the global markets also, maybe the foreign investments are also at a dry up right now. So, but India per se has a lot of investor base and, those are doing very well. Yeah. But yes, the money that we are getting from the foreign investments may be at a very slowdown right now, or maybe at a careful watch right now. Right. So that is where the headwinds are moving right now. But the entrepreneurship and the journey for startups has been very encouraging in the last 2 years, even in onset of the pandemic.
Absolutely.
Yes, more focus has gone on technology side of maybe e-commerce platforms and fintech and edtech, and all are getting more attraction from the investors.
Right. No, absolutely. I think that's wonderful. Thank you, Falguni. Manojji, should we start the?
Yeah, sure.
Session on pharma.
And Falguni, we request you to also contribute your thoughts on the pharma sector as we go along.
Yeah, sure.
We already discussed some startups in the medical space, M-Fine, also retrenching people. So lots of, it's all from startups, small companies to big companies, it happens. Yeah.
Yes.
Now we'll talk about some of the successful companies also and what they are going through.
And specifically, Sun Pharma is talking about Santosh, so that would be quite interesting.
A deep dive into Sun Pharma, very deep dive.
Yeah. So once again, good afternoon, everyone. So this next few minutes, we'll talk about some of the large pharma companies results, March 22 results of few pharma companies I have picked up for this week. Sun Pharma, as you can see, Torrent, Lupin, and Divis Lab. So basically, one of the reason I picked up pharma again, of course, last week we discussed NBFCs, is because many pharmas did make the news for impairment and discontinuation of certain business lines. Last couple of years, as we know, pharma companies, especially the ones riding on the high of the drugs related to the pandemic, favipiravir and thereabouts, had actually quite a windfall gain in terms of revenue. So this quarter, in fact, the trend is slightly different. So let's start with Sun Pharma. As you can see, the revenue, I'm focusing on the annual revenue here. Sorry. So the top line is 38,654 crores. Profits, I'll come to exceptional items, but before that, profit before loss of 4,481 crores. Profit after loss of 3,405 crores. They have exceptional item of 76 crores, and last year it was correspondingly it was 409 crores. We'll talk about the notes. Yeah, I'll zoom it a little bit. Yeah. Okay, let's go to directly note number 4. So note number 4, last financial year, June 2020, Taro, so they had acquired Taro a few years back. I think it was 2-3 years back. It globally resolved all the matters in connection with multi-year investigation of Department of Justice, Antitrust Division, and Civil Division of the US generic pharmaceutical industry. Under the deferred prosecution agreement reached with DOJ Antitrust, the DOJ filed an information for conduct that took place between 2013 to 2015. So basically, they had made provisions towards this litigation in the US. You know that whenever there is litigation in the US particularly, there can be far-reaching financial implication. So that is one of the exceptional items. The current update is that during the current quarter, I'm looking at the last paragraph, SPI INC provided USD 15.3 million for payments to DPPs. This along with related legal charges of 5.5 million pertaining to lawsuit, equivalent to 1,562 million inclusive of legal charges, has been disclosed as exceptional item during the quarter ended 31st March 2020. So basically, they have made additional provision towards this litigation in the US. This is, again, in the US, most of the companies do face this, Indian pharma companies do face this antitrust litigation. So this quarter, they seem to have taken a stock of that litigation and made an extra provision towards it. Of course, one may actually look into why did they not provide for this in the last quarter or the quarter before that. The other notice results for year ended 31st March 2022 includes charges of 1,500 million towards impairment of acquired intangible under development. Further, the group disposed of the assets, which was classified as assets held for sale as per the requirements of Ind AS 105, and a write-down of 38 crores was taken in the quarter ended June 21 and disclosed as exceptional item. Again, this financial year, they have also made impairment towards certain intangible assets under development, which they had acquired. Now, many pharma companies had in fact acquired the rights to, the development rights for further molecules in anticipation of, COVID-related, requirements for, COVID, related to COVID. And this financial year, quite a few of them have had to make an impairment provision towards that. Then there is, I'm looking at note number F now. The parent company and its subsidiaries are defended in a number of class action suits brought by purchasers and payers of US and in the US, alleging violation of antitrust laws with respect to its ANDA for certain drugs. The cases were transferred to the US District Court for District of Massachusetts for coordinated proceedings. With a view to resolve the dispute and avoid uncertainty, a settlement without any admission of guilt or violation of any statute, law, rule, or regulation, or of any liability or wrongdoings was reached with all the plaintiff classes on March 23rd, 2022 for a total settlement of USD 485 million. And incurred related legal charges of 8.3 million pertaining to this lawsuit. So again, they had a provision of 489 crores in the current quarter. So again, another case of antitrust in the US for certain drugs, and they had reached a settlement of this towards this. MAT credit, and based on reassessment of write-off MAT credit of 440 crores disclosed as exceptional item. So again, they took a stock of the MAT credit entitlement. We know that MAT credit has a life of 15 years. So if you can't utilize it for 15 years, you need to write it off. So in that process, they have written off MAT credit and exceptional and treated it as exceptional item. Then there is a scheme of amalgamation and merger of Sun Pharma Global FZE with the company as approved by the NCLT in August 2021. Sun Pharma Global FZE merged with the company with effect from 1st Jan 2020. So again, this is normal Ind AS 103 disclosure. COVID, they have given a general note, nothing very alarming in terms of COVID. During the quarter and year ended 31st March 2022, our subsidiary Taro has acquired outstanding capital stock of Galderma Holdings and others, proactive. Accordingly, the results are not comparative. So they had acquired some company in the US through Taro. That disclosure they have given. Again, they have acquired additional 11% in Xenotech Laboratories, which is a subsidiary of Daiichi Sankyo, for a total consideration of 53 million rupees. So that's not a very big acquisition, stake purchase as such, but that note also they have given. Standalone, again, they have given one note which I would like to talk about. They have given the EU, the antitrust note regarding the antitrust litigation in the US. Yeah. So, Manoj, what do you think? This has been a difficult quarter for them in terms of impairment and, you know, write-offs and exceptional items.
Well, in the pharma industry, particularly who are large exporters and particularly to US markets, last few quarters, in fact, last couple of years have been quite difficult, except for COVID related new business. There has been a lot of pricing pressure on the products since the last couple of years. So that is leading into margin erosion. So our pharma companies were used to very high margins. Exports were giving much higher margins. Actually, exports to regulated economies, regulated countries like USA, you know, very strict FDA. So strict regulations led to higher margins, upwards than domestic margins, even upwards by 5-10%. But now those margins are getting eroded because of highly competitive pressures and also due to government pressure by various lobbies. So that is one as a business. And now,
yeah, Manoj, absolutely correct.
Conditions,
The other factor is,
yeah.
I think, the increase in the API prices, which has further shrunk the margins of you know, these pharma companies.
Right. Those are supply chain considerations. Yesterday, I was speaking to one CEO of a top company who has just come from Davos last week. You know, the Davos, India, he was saying India is the highlight of the Davos discussions, and mainly due to supply chains. We talked about API as a part of the supply chain system. And because most of the countries, they want to have a very good two sources. I would say two sources. India doesn't become the second source. India can become the first source in many businesses. It can become the second source in some businesses, but two good second sources. It doesn't mean the first source can be 30% and second source can be 1-2%. So we are not dependent. That means the global corporates are not dependent on a single supply chain source. So APIs, we saw dominance of some particular country which had undue advantages. No democratic processes, you know, and regulations also very opaque. So API, the business went up. In fact, in India also, in future, API production is going to increase. We saw so many IPOs of companies going in for API.
No, absolutely. In fact, a couple of editions back, Economist, the global edition also had India on the cover page. The Indian economy and the prospects of Indian economy on the cover page. In fact, they had quite a few articles dedicated to the Indian, you know, the promise that Indian economy is showing. So globally, I think they are looking at India as a alternate to supply, you know, source to China, as they are with other economies like Indonesia, Vietnam, etc. But India is, of course, the biggest one. So absolutely.
What we see, there is a very good degree of optimism about pharma companies at Davos also and globally also. The business models are good. The product lineups are good, whether in formulations or in APIs or in distribution, whether in India or whether in countries like USA, Europe, Japan. So it is quite shocking. Companies should use this, what they call impairments. Suddenly in this year and this quarter, it has not been bad to require cleanups. Business is good. In some areas, some investments will be there. On the long term, they are sustainable, profitable investments by most of the good pharma companies. Unless it's a bad decision, total failure, negligent decision, which has not worked in acquiring a company, due diligence has failed, and then you write off that in a revaluation or when you do a recheck on impairment valuations. To see such large write-offs, that also by established companies, establishment management, that is throwing off a kind of a shock in the minds of the stakeholders. If good companies are coming out with such write-offs, tier 1 companies, what about tier 2 companies and tier 3 companies? Well, actually in the tier 3, maybe the need for cleanup may be much more in that case. So what is a sense on that?
No, absolutely. I mean, with impairment, always the issue is whether, it's too late or whether it's too early, because the initial time, an impairment issue, particularly in, lucrative market like US, comes to, the know of the auditors or the management, generally people try to shrug it off as though, it's just a temporary phase and, things will be better next quarter. But ultimately, if, constantly in a couple of, 2, 3, 4 quarters, if the things aren't looking very promising, that is when, typically a company takes an impairment hit. So obviously with impairment, always the issue is, is it too late? Or is it, should there have been any early warning, kind of signals to the investors? We'll look at another company, Torrent Pharma, again, which I have picked up the, not the results, but the, what is it called? The press release, which is also quite insightful. So Q4, let's look at the annual revenues. So annual revenues of 8,500 crores versus 8,000 crores last year. So a growth of about year-on-year growth of about 6%. Gross profit of 5,800 crores. 6,065 crores as against 5,800 crores, which is a kind of constant. EBITDA of 2,621 crores as against 2,500 crores, again 4% growth. Exceptional item, they also have exceptional item of about 485 crores. We'll see what is it. And finally, PAT of 777 crores. Versus PAT of 1,252 crores. So big decline in the PAT, 38% decline in PAT as against current last year's. Let's see what is the exceptional item. Sorry. So again, US is the bane of the issue for this company also. So US revenue is up to 182 crores. So as a group, US revenue doesn't seem to be contributing significantly to the group revenue, because otherwise, if you look at Dr. Reddy's or Aurobindo or Glenmark, some of the these companies, the US contributes a lion's share of the revenue in those cases. But in case of Torrent, doesn't seem to be the case. Revenue grew sequentially by 20%, aided by launch of DAPS1 during the quarter. Basis assessment of financial viability of its liquid business in the US, taking into account incremental investments required for bringing the pipeline products into the market and increased competition intensity, the company has considered to be prudent to discontinue liquid facility operations. The operation cost of this facility is 135 crores per annum. So therefore, there is a kind of a exceptional item on account of closure of liquid facility operations. And then they have given the US FDA approvals that they have received. So again, kind of a very, I think again in this case, the analysts expectation was not really met by this company. Again, a very tepid kind of results.
It's interesting. Samir Mehta, chairman, has himself explained the failure of the business or divestment, which has caused a huge impairment of 485 crores. It is huge. So this shows if investments can be huge and in good times, in bad times, after margin erosions, one should not be shocked at large impairments also if the business is in a down cycle.
Right.
And at a chairman level, this is shown what normally happens. Strategic decisions when the companies take, they plan to stay in some business and they plan to expand some business, and some other business they intend to downscale or exit based on strategic success stories. They want to focus on good, strong businesses. And here, generally, if they divest business or looking out for divestments, and there are other players as a measure of consolidation, they like to buy the business. But there, as you mentioned, there should be early warning signs. The company should be on the lookout for divestment of this liquid business for some time. Normally, that process may take 1 to 2 years. So there should have been discussions on the quarterly basis about the progress in terms of divestment of a business. So in that case, there is a maybe a marginal loss rather than a total write-off. So then that impairment could be much lower and expected, and there could be early warning signs. Not come as a shocker and what comes to the business, but the chairman making the statement is vital. But the chairman and the management should give indications before, and also try to minimize the impairment and losses by way of strategic divestment or sale at the right time and in the right process. There are many people who want to look out for businesses, not only from India, from other places also.
That's right.
And if you're getting at good prices, and there is always a price at which a business can be sold.
Coming to Lupin now, again, this is a good snapshot of the company, which they have given in the investors presentation. Market capitalization of $4 billion, revenue of $2.2 billion, EBITDA of 311 million. In terms of, I'm looking at the pie chart now, 36% of the revenue comes from North America, primarily US, which is just short of the contribution that comes from India, that is 38%. And the rest of it is, shared between, EMEA, growth markets, rest of the world, API, etc. Globally, this is the 10th largest generic company and 6th largest Indian pharma company in terms of sales, and 3rd largest in the US by prescription drugs. It's 3rd largest, 6th largest Indian pharma company by market rank. Sales snapshot, they have in terms of absolute values. So 13,000 million comes from India, 14,000 million comes from North America, and the rest of it is shared. They have in the current year completed the acquisition of brands from Anglo-French. They have completed Southern Cross acquisition in Australia. Lupin and Yabao announced strategic partnership in China. Lupin and Exantia entered into a license, supply and technology sharing agreement for certain drugs in the Middle East and North Africa. In the pipelines, they have US FDA approval for certain drugs. And they have undergone an inspection from the US FDA for their Tarapur facility. EBITDA of 2,800 million rupees and an R&D spend of 8.9% of sales of 3,442 million. I won't go through everything, but here you have the quarterly split. Again, Q4 is just shy of Q3 sales. So Q4 had 13,000 million as against 14,000 million in Q3. Won't get into this performance P&L highlights. So here again, sales Q4 38,000 million versus 40,000 million in Q3. Profit after tax, there is a loss of 5,119 crores, 119 million. Again, there is a small exceptional item of 12 million on account of one-time expenses related to residual metformin returns, some sales returns, looks like. Annual sales of 1,61,000 million versus 1,49,000 million, so a growth of 8.5%. And then you have the profit after tax. There is a loss of 15,000 million as against 12,000 million. So basically, there is a decline in the EBITDA by 14% year on year. Again, I think this is largely because of the pricing pressure that he was talking about, as well as the increase in the input cost that is there.
He wrote to me, okay, no issue, you send a picture on WhatsApp.
Request the person to somebody disturbing.
Standard
Who is this?
How you reply?
Who is this?
I send a registered for sale. Say what he told you.
Yeah, I'm muted him.
Yeah. Yeah, carry on.
Take on Lupin, Manoj.
Sorry?
Your take on Lupin?
Yeah, Lupin, there are quite interesting things. There are two things. One is the exceptional item. As per the release we discussed, is about 16% of the annual turnover. Right? They had given. Now 16% of annual turnover is very, very large. These companies reach this stage after 30, 40 years of business development. And then the US market itself, they are over there for over 2 decades.
Right.
And the margins in this business, net of R&D cost are below 10%.
Right.
Net of R&D cost, even 5-10%, but R&D cost, we can say is an essential business which can give in huge growth. So if you exclude that, then also margins are ranging from 12 to 16%. And if we have just write-off exceptional item of 16% of 1 year's business, it's a very, very big shock. It's only a company like Lupin which has decades of history and they have accumulated reserves and strength. They can survive with such loss. But if it happens for a company which is in a startup phase or growing phase of first 5 years, and if they show the honesty of this impairment, let's write it off. 16% of business, that company may not be able to survive also.
Right.
So that's very, very important. And in Lupin, one interesting thing happened. The head of finance of a company who was there for quite a few years, he left. There were apparently some issues or differences where the directors and the CFO were talking in a different language with the key stakeholders. Now, after a gap, he has joined the company back. So why this impairment is there? Is it because then decision has been taken after he has joined back? Suddenly an impairment.
Yeah.
And things will improve. This time also, when this report came suddenly, they are talking about only one or two more bad quarters. Then the company will be on a good wicket. So they are saying second half it will be good. This is like the banker saying just since last decade, only 2 quarters ahead. But why did not talk about this 2 quarters earlier?
Yeah.
So this puts the whole year in a very challenge. We don't know whether it will be able to recover their first quarter loss so easily and make up to have a good business. But it was not a surprise. Even other companies like we already saw Sun Pharma and Torrent have also written.
Yeah.
Their reserves are coming down. But these are strong companies. We are more worried now actually about other pharma companies.
Yeah.
Why they are not, if they are not coming with impairment, why not? As we talked about Divis also, the result was good, but again, no impairment there again became a shock and the stock price reacts because they say future is uncertain.
Yeah.
So
Divis again, the revenue is 8,959 crores versus 6,969 crores last year. If you look at the, there is a significant increase in the cost of material as compared to last year. Profit, there is no exceptional item here, unlike the other 3 companies that we saw. Profits have also increased, although not in the same proportion as revenue, but you have 2,960 crores profit after tax this year versus 1,984 crores last year. So about 1,000 crore increase in profit after tax. Talking about some of the significant developments during the current year. The group is engaged. This is all fine. So I think, yes, they have only disclosed the impact of Forex on their results. Forex gain has contributed significantly to their profits. So this quarter, there is 31 crores gain, and this annual financial results, there is a 40 crore gain versus 4 crore loss last year. Again, so there is all these export focused companies have gained on account of depreciating INR. So yeah, nothing more to add in this aspect. This was a relatively, not so, I mean, there was no exceptional item or impairment in case of Divis laboratory. So that's about it from my side. 4 pharma companies. I think again, very interesting quarter for pharma companies, as far as financial results are concerned. Watch out for this space. Next quarter, I think things will bounce back and we'll see how things work. Manoj, last words from you.
Would anybody like to comment? Or
no,
give
very nice session, Santosh.
Falguni?
Quite deep diving into the numbers, Santosh.
Falguni, put on a video.
I'm sorry, Falguni, didn't catch that. Sorry, what are you saying?
I said that very deep, insightful numbers and story about Sun Pharma and how the other pharmaceutical companies are doing. Thank you so much, Santosh. It was brilliant hearing you.
Thank you.
Falguni, what do you expect from Pharma AZ? It's a new company, unlisted space, coming out at IPO. Does it make things more difficult?
This is the space now it's going to be in, like pharma tech is going to be one of the more innovative. I do not know more on the business model that they have adopted. What is their backend, whether they are lean and all. I haven't seen the pharma's easy numbers, but I can tell you that, it's definitely the new age scenario. I mean, they are in the right space. This industry is going to do good. They are, their model is correct. The business model is correct. The numbers need to be seen.
I'm getting it from people who came from Davos. One is the CEOs of companies and also top level government bureaucrats. They say pharma is a good space to be in from way of global perspective, and there are good, very good ample opportunities for pharma companies.
Correct, because healthcare is a very important segment. We all have already seen pandemic and also otherwise.
Some states have a very good ecosystem already. very strong, and some are keen on developing it because there is huge demand.
Huge demand and huge potential.
So
even healthcare is also seeing a huge tech dominated business models.
So we look at covering of more sectors and more companies as things evolve on a day-to-day basis.
Yes, Manoj.
Great work. Yeah, great work, great insights.
Yes. I think we can end the session.
Okay. Thanks to everybody.
Thank you.